Good morning. Is the court reporter ready?
I'm ready.
Thank you. Any preliminary matters before we jump into it? Commissioner Gilman?
I do just have one that I wanted to bring up in preparing for the testimony of Mr. Matley. I hope I'm saying his name right. I was reviewing the attachments to his testimony, and hearing exhibit 123, attachment RAM-4, was filed as confidential. We have not been able to locate a non-confidential version to understand if any of the materials are not considered confidential. So I think it would be very helpful in preparation to understand from the company what specific aspects of this exhibit are actually considered confidential, which would very much help in preparation to be able to question the witness. And I'm not sure if we need that right now, if you all can respond so we can understand the confidentiality claim for that document.
Ms. Brahma?
Ms. Gilman, or Commissioner Gilman, excuse me. The company has been working with the commission staff to file a non-confidential version of that. There's primarily gas commodity cost data in the model, but it does permeate the model. And so I'm not sure that we can prepare a public version that only has certain items as confidential or non-confidential because the data permeates the model itself. So I'm not sure that that's exactly what you were hoping to hear. And I can talk to Mr. Matley and see if there's anything else to be done. But I don't know that we have the ability to do a model that's partially confidential and partially public.
Okay, so is it the case that the only confidential kind of input here or aspect, understanding, perhaps someone very skilled could back calculate if that's blacked out, but the only really confidential aspect going into it is the gas commodity forecast?
I believe that that's the case. If you don't mind, I would like to verify that when we have a break in the action today with Mr. Matley and just make sure that there's nothing else that I'm forgetting or missing as we're talking this morning.
Can I just ask you, is the sales forecast confidential? I've been dancing around that, but
we'll have to double check that as well. Obviously, we have sales forecast data in the case that is not confidential in Mr. Goodenough's testimony, but the longer term data I'd have to check with Mr. Matley.
okay.
And as we go forward, I think this is an issue we've kind of seen in the past, and just to the extent it makes it difficult, certainly to question the witness. And I think for transparency purposes, part of the reason to get a rate forecast is I think it's helpful to have as part of the record for transparency in the proceedings. So limiting the extent to which it can be discussed in the public forum of the hearing is somewhat difficult. And I wonder if it really is gas commodity forecast, couldn't this commission just give you a number and an escalation factor to be used to say, this is what the commission put in here? I mean, I don't think publicly available forecasts vary all that incredibly much that we might not be able to get some actual outcomes with something that is set that does not disclose what the company believes.
Yeah, I think that I understand the concern. It's certainly the company is not trying to make anything confidential that we don't need to. We prefer to keep things public to the extent that that's a possibility. So if it is acceptable, I'd like to take this back to Mr. Matley and the team and have a conversation on the break and then bring back what we think we can do. That actually relates to one of the preliminaries that we have this morning as well, which is we have a few witnesses who need to who have travel or other issues today. And so we were actually thinking it may be helpful to talk about that briefly and push Mr. Matley a little bit, which may also give us a little time to get some of these things sorted out before Mr. Matley takes the stand so that the commission will have as much public data as we can potentially, possibly provide in order to have that discussion with Mr. Matley.
That'd be great. So do you want to give us the travel schedule now or?
Yes, I think that would be helpful. So, I
Still not
have-
on the record. I hope that's okay.
Yeah, that's fine.
Okay.
So we have Mr. Johnson, of course, will be finishing. We were prepared to go ahead with Ms. Gilliland next. And we understood that the commission is looking to talk with her sooner rather than later. If it would be acceptable, if we could do Mr. Deslich before Ms. Gilliland and then Ms. Gilliland, he does not have a lot of time reserved, for cross. And we think we'd still get to Ms. Gilliland today. If there's a desire to get to Ms. Gilliland first, we'll make that work as well. We may have to push Mr. Deslich to next Tuesday.
No, I think that's fine.
And then we would move to Nicole Doyle and Mr. Amen. And then I guess we'll see where we are at that point. That might take us, if we get to the end of the day, I think Mr. Matley would then follow Mr. Amen. But I have to see how the day unfolds.
Can we, if we do end up, maybe we just plan on Mr. Matley first thing on Tuesday. So if we needed a confidential session, we could just do that first thing in the morning.
That would work for the company.
So let's just lock him in first thing on Tuesday.
Okay. If we get through the others, then today we would have on Tuesday, Mr. Matley, Ms. Bulkley, Mr. Pette, and Mr. Freitas.
Okay.
I believe we just wanted to confirm as well. I think the intention was, of the commission was to end at 3:30 today. Just planning purposes.
Yeah, that's the plan, and maybe we'll keep lunch to 30 minutes.
Okay, thank you for that update. We do have two other preliminaries. One, I think we may want in the record. It pertains to the discussion Commissioner Gilman had with Mr. Moeller yesterday, and just make sure we think we maybe found a correction that would be clarifying in Mr. Moeller's testimony, which I can talk through, and then we can determine if we need to have any further activity beyond that. And
Yeah,
then,
Miss Weisenthal, why don't we-
Could you
we're-
officially go?
yeah, we're back on the record now.
okay. Would you like me to start with that? I think we have two other preliminaries, or two preliminaries this morning, Commissioner.
Yeah, go ahead.
Okay. The first one is, we had talked, there's a conversation yesterday between Commissioner Gilman and Mr. Moeller with respect to his supplemental direct testimony. It was page 10 with respect to the results of the analysis of the cost per linear foot of retiring a line in place versus full removal. Would it be okay if we pulled up that testimony for just a moment?
Yes.
And just explain what we saw.
Sorry, can you say the number one more time for me?
Absolutely. Hearing exhibit 121 at page 10.
And can you tell me the witness? Sorry, when there's so many numbers, it's easier to find the witness.
Mark Moeller's supplemental direct testimony.
Thank you. Give me just a second. Did you say page 5?
Page 10.
10.
If we could scroll down to the question that starts on line 15. Thank you. So there was a little bit of, I think, confusion and unintentionally, of course, on our part, but sometimes we discover things in the course of having these conversations. Mr. Moeller's discussion here with respect to the $22.24 per linear foot was intended to say that is almost exclusively retiring a line in place because they could only manually find 4 examples, or I think it was 4 or 5 examples where removal had happened. So and we have this available in box, but probably the better thing to say on line 16 would have been to say the average cost over the last 5 years, primarily to fully retire a line in place, was approximately $22 to $24 per linear foot. Because this is a total average number, as Mr. Moeller started to say yesterday, it's just that there are so few physical removal examples and they have to be manually found, that it is almost, you know, I can't remember what he said, but 99 or 90 some percent retiring a line in place. So we wanted to make sure we were clarifying that point. I know it was a matter of interest. Mr. Mueller is available to come back. Otherwise, if that's clear, we can offer a Rev 1 to the supplemental direct testimony with that one additional word. And hopefully that helps clarify the discussion from yesterday.
Okay, thank you. Did you have other matters?
I just wanted to confirm that that's how the commission would like us to proceed.
Yeah, unless you think different, Commissioner Gilman, I think I'd just have them refile or revise. We'll see if there's any objections and we'll put it in the record. Does that work for you?
That's fine with me.
Thank you.
So that's just the 121 revision 1, correct?
Correct.
Thank you.
We do have that, I think, available in box.com right now. Would your Chair Blank, would you like us to bring that up at this time or just?
Yeah, does any of the parties have any objection to making that one change in the document? Hearing none, so moved.
And we apologize for any confusion, but obviously wanted to correct it when we saw it. So appreciate that opportunity. The last preliminary item we had was just briefly to update. We are working on the commission's request for CapEx data over a span of time. And we anticipate having more available and having something to be able to provide the commission Tuesday, hopefully first thing.
That'd be great. And if you have it Monday, and can circulate it to the parties and the commission, that'd be awesome. So we have a chance to look at it.
We can do that. Would you want us to file that or circulate it informally, or is there a preference?
I guess Ms. Harper, any advice, Ms. Rosati?
Is this something that parties or the commissioners would be wanting to rely upon?
Yes.
Then it should be added to the record. So moved for admission.
All right. So we'll do it first thing on Tuesday. All right. Any other preliminary matters, Ms. Broma?
No, I think we've covered them. Thank you.
All right. I think Mr. Bunker, you're up with Mr. Johnson. I think you got 20 minutes left.
Excellent. Thank you, Mr. Chairman, and good morning, Mr. Johnson. Can you hear me?
Yep.
Yeah.
All right. Thank you. Let's go back to our discussion yesterday afternoon, and that is you have already stated that Piesco Electric is currently authorized a 55.69 equity ratio, correct?
For the electric, yes.
Yes. And whatever the commission authorizes for Piesco gas in this proceeding will not impact the equity ratio authorization for Piesco Electric, correct?
It won't change what historically was authorized by the commission in the past, correct?
Okay, thank you. Now, if we could pull up and display hearing exhibit 509, you will recall that this is the response and supplemental response to UCA Discovery Request 28-A and attachment UCA 28-8.A1. That's a 4-page document. And if we could look at the first paragraph there, just as a refresher, you'll recall that this question, discovery request, asked for another set of your credit metric scenarios, which are contained on page 13 of your rebuttal testimony. your table PAJ-R-1. And the UCA was asking for another set of credit metric scenarios that propose any changes that only impact PSCo gas and do not impact PSCo electric. And then you'll note in the second sentence, the offer, if you will, that you could assume PSCo electric is 75% of the company and PSCo gas is 25% of the company. Do you see all that?
Yes.
Okay. And then at the bottom of the page in the supplemental response, starting the last line and a half, you indicate attachment UCA 28-A.A1, which simply isolates 25% of the credit metric impact resulting from the scenarios in witness Johnson's testimony. See that?
Yes.
Okay, so if we could go to the essentially what I'd like you to do is walk us, the commission in particular, through pages 2, 3, and 4, which is the attachment to hearing exhibit 509, and discuss this 25% credit metric impact with regard to these scenarios on page 13 of your rebuttal testimony. So if we could go to, you understand that, right?
Yes.
Okay. So if we could go to the second page, can you explain to us what we are seeing in this particular page?
Before Mr. Johnson responds to Mr. Bunker's question, I'd like to just note for the record that the company stated several legal objections to the UCA's proposal here, as well as some discussion in the response about why it's not a legitimate calculation, that the company just did the math at UCA's request. So if we could just have that objection in the record, I'm not opposed to Mr. Johnson explaining what the paper shows with that so noted.
So noted. Mr. Bunker, keep going.
So, Mr. Johnson, would you please explain to us what we are looking at here on page 2 of the 4 pages?
Yeah, this just shows the cap structure for the 4 operating companies and the consolidated entity.
Okay, so when you say consolidated entity, that is with reference to all of PSCo. So that's gas, electric, and steam, I presume, right?
I was referring to, yeah, well, correct on PSCo and also correct on the consolidated 10K, that 40.2% equity ratio reflects the consolidated Xcel Energy company.
So it's Xcel Energy, it's not Public Service of Colorado.
Well, PSCo is the 55.5% equity ratio.
I see that, yes.
And that is the consolidated PSCo entity. Since there's only one balance sheet essentially for PSCo, there's not a separate gas, separate steam, separate distribute or separate electric.
Okay. So just so I'm clear, the consolidated 10K is for Xcel Energy.
Correct.
And the column that says PSCo, that is Public Service of Colorado, and that's the consolidated gas, electric, and steam, right?
Correct.
Okay. Anything else that we should glean from this page?
No.
Objection, that's a vague request.
Overall, he's already answered. And just to be clear, the units on this is millions of dollars.
That is correct.
All right, thanks.
So yeah, capitalization $43.8 billion is no way to look at it.
Okay. And the column UMP borrowings, and then underneath that, there's a single line, looks like a -78, and elimination to remove the short-term borrowings between opcos. What is that?
That's just an accounting entry that you make when you do the consolidation.
Okay, and that applies to the entire Xcel Energy rather than any one of the entities, Piesco, SPS, et cetera, right?
Yes, that'd be for some other subsidiary.
Okay. If we could move to page 3, there's a ton of information here. And can you explain what we are seeing here as it relates to the discovery request?
This is just showing the Excel Energy consolidated balance sheet. And then what it shows, that's on the left side of the page. It is then showing the various debt issuances at Excel Energy and at NSP Minnesota. It is showing the capitalization schedule for Excel and then the individual operating companies. Below that, it is showing the credit facilities for the individual operating companies in Excel Energy. So this is essentially information taken out of the 10K.
Okay. And there are several references in the two middle or in the middle column. There's a debt to total capital ratio, and it shows Piesco there at 44.3% in 2023, 44% at 2022. Is that right?
Yes.
And then below that, there's some shaded material, kind of middle of that second column, if you will. That shows committed credit facilities, right? And it shows the credit facility for Piesco 700, and I assume that is million, or is it billion?
700 million.
Million, okay.
You see the millions of dollars there in the title.
Ah, yes, I do. Now that after I asked a question, thank you. And there is a withdrawal amount of 349 million and an available amount of 351 million. Is that right?
Yeah, so what that means is there was $349 million of commercial paper that was outstanding at December 31st, 2023. It was not
Okay.
drawn on the credit facility, it was commercial paper.
Okay. And looking at the first note just underneath that listing, some shaded, some not, it says these credit facilities mature in September 2027. So this is a credit facility that's available through September 2027. Is that an accurate understanding?
Yes.
Okay, and then on the far right, we have Excel Energy, and these are long-term debt obligations. The top is Excel Energy, and the next is NSP Minnesota, right?
Correct.
And while public service would be part of that Excel Energy column, perhaps at the segment of the table on top, it would not be part of the NSP Minnesota table below that, right?
Public service company is not part of the debt outstanding at the Excel Energy level. That is strictly debt issued at the holding company level.
Okay. Okay. So now if we go to page 4, help me with what we're seeing here. We see 4 columns, if you will, and these are the 4 subsidiary operating companies, right?
That is correct.
Okay. And so in this middle or the third over from the left, this is Public Service of Colorado, right?
That is correct. It's extremely hard for me to read because it's so small. So I don't know if you can make that bigger.
We're on this column right here, correct?
Yes.
Yes, thank you.
let me know if you want me to do it bigger, but that's probably all I can do to get the full table. But if you want me to zoom in a certain part, I
I think I
can.
can get it. My eyes are not what they used to be.
Well, I think most of my questions, Ms. Frederico, are going to concern this third column, which is public service. So if you want to focus on that third column and enlarge it even more, so people can see it a little easier, that would be terrific.
Yeah, so this is only size where I can show the entire column. If you want like the top, bottom, middle, I can make it bigger. But to show the entire thing, this is the only way. This is the only size I can get.
Okay, I understand that. Thank you now. So Mr. Johnson, what are we seeing here in terms of it's a consolidated balance sheet, but explain that with regard to how it is related to your table on page 13 of your rebuttal testimony.
So this is the consolidated balance sheet for Public Service Company of Colorado as of December 31st, 2023, from the 10K that we filed for Piesco. So it shows all of the assets, liabilities. So you can see there's, what is it, $24.6 billion worth of assets, similar level of debt, or excuse me, of equity and liabilities. And so you see the long-term debt totals, you see the amount of equity, you see the current portion of short-term debt, and then also the current maturities of any long-term debt that is due within a year. So that's basically where you would pick up the capital structure for the operating company.
And again, where would that particular, the reference you just made, which part of this table are we looking at for that?
All right, so the capital structure, so if you look under current liabilities, you see current portion of long-term debt, which looks like there is 0 there. And then you see borrowings under money pool arrangement of $51 million. And then you see short-term debt of $320 million. So that's the short-term debt. So basically about $371 million, if my math is good. Then if you go down to capitalization, you'll see $7.450 billion worth of long-term debt, and you will see $9.742 billion of equity. So the combination of those items are what makes up the capital structure for Public Service Company of Colorado.
Okay.
So if you do the math on that, what you'll find is that the debt or the equity ratio would be approximately 55.5% or thereabouts.
Okay. And that is okay. So how does this relate back to your rebuttal testimony table on page 13? And if you could, Ms. Frederico, if you could keep this document handy, but go to hearing exhibit 126. Yeah, page 13. And here is your credit metric scenario table. So if you can help us with the interplay, if you will, between this discovery response and attachment and this table.
So the table that shows the balance sheet shows that, you know, that's where you come up with the equity ratio. So as we talked about there at the end of 23, the equity ratio for Public Service Company of Colorado was approximately 55.5%. In this proceedings, we have suggested lowering the equity ratio down to 55%. This table reflects that equity ratio of 55.0%. And then the scenarios are the scenarios that the commission has requested in the past and other scenarios that reflect the UCA and the staff's proposal.
Okay. Okay, so you will recall that yesterday we talked about Moody's and the downgrade threshold at 19%, which we see discussed at the bottom of this testimony page, starting at line primarily at line 10. And it regards the cash from operations pre-working capital to debt, or the CFO pre WC/debt for 2024 and 2025, right?
Yeah, you could probably just refer to the CFO to debt, just make it easier for yourself.
Okay, CFO to debt. Thank you, sir. Appreciate that. So when we're looking at the CFO to debt ratios here on the bottom two lines of the table here on the top of page 13, how do these percentages change with regard to the 25% scenario that we just walked through in the attachment for public service gas?
Well,
Thank Mr. John, sorry about that. I just want to make sure we register our objection with respect to that discovery request and its relation to this scenarios, which are different things.
I think it's been registered, Ms. Brahma, so thank you. Keep
All
going,
right,
Mr.
so
Bunker.
to try to answer the question. So the equity ratio that is listed at the top line of all the scenarios is based on the consolidated entity for Piesco, which is electric, natural gas, steam. There's one company, there's one capital structure, there's one balance sheet. The data request asked us to say what would happen if we only adjusted the capital structure for the natural gas sector. Obviously, that is, something we can't do. There's not a separate capital structure for the gas division. So that's why we objected to it. We then did, well, what is, if we assume some kind of 75% hypothetical equity and 25% for natural gas, what would that be? And so although we didn't agree with the analysis, we don't think it doesn't think it's realistic, a realistic scenario. We tried to do the math to honor the request of the discovery request.
Okay. Looking at the table, scenario 6 is UCA's proposal, right?
Correct.
And in the UCA proposal, the equity ratio that's proposed is 51.4%, right?
Correct.
So stepping back to the discussion we've been having here regarding the attachment and the discussion that you've had, or the statement you've made, that the equity ratio for public service electric is 55.69%, right?
That was the level of authorization in the last electric rate case.
Okay. And if that is weighted at 75%, and the UCA's gas ratio of 51.4% is weighted at 25%, my math suggests, and this would obviously be subject to check for you, but this would average 54.62%. Would you generally agree with that?
I have not done the math, so I can't make that statement.
Does it sound reasonable, subject to check?
I'll say that without checking, and I'll assume that you have relatively solid math skills, and I have no reason to believe that you did not do that accurately.
Okay, thank you for that. I appreciate it.
It's a vote of confidence.
Excellent. I like that. Thank you. Okay, so if the if the commission adopts, well, let's look at again the CFO to debt, to debt percentages here. And for the UCA's proposal in 2024, you have 18.5%. And for 2025, you have 19.0%, correct? In your table?
Yes.
Okay. So if the hypothetical or the scenario we just walked through results in a 54.62% equity ratio, that would bring the CFO debt for 2024, it would likely bring that up above 19%, wouldn't it?
Yeah, if the consolidated equity ratio was 54.5%, I would agree with that, yes.
Okay. And the 2025 CFO to debt, that would, it's currently at 19%. Under a 51.4% equity ratio. So it would clearly jump above rise above 19.0%, right?
That is correct.
Okay.
I think it's also important, if that were to be the case, the gas customers would be getting the benefit from a higher equity ratio that is not reflected in the cost of service for those customers. So essentially, the electric customers would be subsidizing the gas customers in that regard.
Okay. And in your supplemental direct testimony conclusion at, let's see, that is hearing exhibit 119. In your conclusion on page 19 at lines 3 to 8, you suggest public service would avoid a credit rating downgrade if the base rate revenue requirement was established consistent with the return on equity and capital structure approved in 22AL-0046G, correct?
Yes.
And that would be your, if we could jump back to your hearing exhibit 126 and the table, that would be your scenario 5 in the table. Is that right?
Correct.
Okay. Okay, let's move to another topic, which is you brought up the levers model in your direct testimony. And you discussed this lever models and included as attachment PAJ10 to your direct testimony. Is that right?
Yes, the levers model was included in the testimony as requested.
Okay. And this is the same levers model that was discussed quite extensively in Public Service's fully litigated 2022 gas rate case, right?
It's very similar. We may have made enhancements to it, but yes, it's the same basic model.
Okay. And looking at your supplemental direct testimony at page 12, it's hearing exhibit 119 at page 12. Here you go into a little bit of an explanation regarding the fact that the levers model, and this is on lines 1 through 14 on page 12, the levers model enables the commission and the parties to assess credit metric impacts of various ROE and equity ratios. Is that correct?
Correct.
And at page 6, or at lines 6 through 7 there on page 12, you specifically state the mathematical model requires inputting a particular ROE and equity ratio, as it cannot produce a range of result, or produce a result based on ranges. Is that right?
It's mathematically impossible to put a range in. You could put individual numbers within the range and do the calculation, but you can't put a range in there and have the model spew out different numbers based on every point within that range.
So my recollection from the 2022 case is that when you input a particular ROE and equity ratio into the levers model, it produces a result that calculates the debt percentage and the WACC percentage based upon the ROE and equity ratio inputs. Is that a simple way of thinking of this model?
Could you repeat the question, please?
Sure. Is it correct that inputting a particular ROE and equity ratio into the levers model produces a result that calculates the debt percentage and the WACC percentage based on those ROE and equity ratio inputs?
Correct, and then it calculates the credit metrics based on that.
Okay. And referring to your rebuttal testimony now, hearing exhibit 126 at page 10, here you generally discuss the capital structures and the various ROE and equity ratios produced by UCA and staff, correct?
Correct.
And with those various ROE and equity inputs, the levers model can generate the capital structure showing the debt percentage and the WACC percentage based on those UCA or staff ROE and equity ratio inputs. Is that right?
I mean, the levers model is a simplistic model that we provided to the commission and to the interveners to essentially get a ballpark range of credit metrics based on different scenarios. For the actual scenarios, we ran more detailed models, which we provided in the attachment to calculate the impacts of various scenarios and various recommendations. So there is nuances between the two.
Okay. I think that completes my cross-exam. Would you give me just a moment to look at my notes?
Yes.
Yes, that completes my cross of Mr. Johnson. Thank you, sir. Appreciate it.
Thank you, Mr. Bunker.
Thank you, Mr. Bunker. Commission Counsel, any questions?
No questions.
Commissioner Plant?
Thank you, Mr. Chairman. Good morning, Mr. Johnson.
Good morning.
I'm still trying to understand sort of the way that the credit agencies evaluate the companies, particularly as they're blended here with the electric and the gas. And so I'm trying to specifically understand sort of the impacts of the capital structure on the credit evaluations for the combined companies. Before I get into my questions, I did have some follow-up questions that were raised from Mr. Bunker's cross. So I just wanted to ask a few things I was still confused about. So you mentioned when talking to Mr. Bunker that gas customers would be benefiting from the credit impacts of the electric system in his scenario, but isn't that going to happen anyway because the credit rating process is a consolidated evaluation? It doesn't happen individually for the gas and the electric companies. So one is going to naturally benefit the other?
Well, not really, because again, if you have a similar capital structure for both the gas and the electric, the credit ratings reflect the consolidated entity the cost of service represents the consolidated equity structure.
Okay, so you're sort of advocating the same or similar capital structures for both, so that there's not one that would have an influence over the other. Is that?
Well, the commission has always has the ability to determine a different capital structure for each, for the electric or the gas. We then as a company would have to determine how would we handle that. So there's basically, in my mind, two different ways we could do that. The first would be, okay, we'll come up with an allocated capital structure based on the different authorization levels. That's one way. The second way would be to make a determination to, for example, if the gas sector, if you took the authorized equity ratio from 55 to 54%, we could determine, well, is this where the electric is going to go in the next proceeding? Has the commission given us a site saying this is where they think the capital structure should be? And therefore we could say, okay, at that point in time, maybe it makes sense for us to manage to the lower cap structure. So we would have to determine how we would handle a different authorization level for each entity.
Okay, I understand. And you also said that the 25% that Mr. Bunker and UCA proposed is inaccurate. Is there an accurate number or that you know, or that you could estimate?
I was merely saying that is not, I didn't say it was necessarily inaccurate. If I did, I meant it's not realistic, because that's not the way we manage the company.
Okay, so
I'm not sure what the exact allocation between electric and gas, based on whatever measure you want to use. If you want to use rate base, etc., it's probably somewhere between 20 and 25%.
okay, so but you're saying that because they would have the same capital structure under what your assumption is here, that they would have the same capital structure. If it's 25%, if it's 20%, if it's 30%, it doesn't matter really, because they have the same capital structure.
If they have the same capital structure, it doesn't matter, correct?
Yeah.
If we're
Okay.
doing an allocated capital structure based on two different entities, yes.
So then he's saying, what would the blended cap? I gotcha. Okay. And one of the other things I think yesterday, Mr. Bunker referenced the changing nature of debt in reaction to various market forces, including quarterly action by the Fed. And in those cases, between rate cases, if something happens that changes those rates, what happens? Does the WACC change, the ROE, the capital structure? Is there a truing up process? Does it impact the next revenue requirement in the next rate case? What happens to sort of, if the actual debt that you issue has a different rate? Because
so let's assume that the rates are set, and it's based on some cost of capital, some cost of debt, etc. And then for simplicity, let's assume that the cost of short-term debt is 5%. If the excuse me, and let's assume that this is based on historic test year and nothing changes in the next year. Everything, costs, revenue, all at the same level. But let's say that short-term debt goes down to 4%. The company would then earn above that level. If the cost of debt went up to 6%, then the company would earn less, because its rates don't reflect that. So once the rates are set, and this is not only for short-term debt and long-term debt. Obviously, costs and revenues change, and the company then has to try to manage based on the different levels and revenue.
So basically, it would float within the ROE.
Yes, the earned ROE would reflect the change in assumptions from what was authorized in the rate proceeding.
Okay, great. And one of the things in your testimony, it was response, I think, to Mr. Fernandez. He had said that the natural gas business is too small to have a significant impact on the company's credit rating. And you disagreed with that. But then a couple of days ago, the chair brought up the investor presentation from Excel. And we saw that about 19 out of about $19 billion of proposed additional capital, something like 2.5 billion was attributable to the gas business. Is that something that the credit agencies would look at, or would that level of investment on the electric side be of more interest to credit agencies that in their consideration of evaluating the company?
They're going to evaluate the Fiasco based on the total company. So they're not going to necessarily they're going to look at the individual decisions that are made in regulatory proceedings, more from a standpoint of what kind of revenue does that provide. But they're also going to look at it from what kind of insights do they get and how the regulators are viewing the company. They aren't looking so much at what is the gas capital investment versus the electric capital investment. They're going to look at the total investment and say, well, okay, how is this going to be funded? What is the impact on credit metrics, et cetera? But they're not looking so much as the breakdown between the two entities.
So the size of the investment, if Excel is saying in their investor presentation, we anticipate investing $19 billion in the next 4 years. The size of that investment really doesn't impact the credit evaluation. If they said we're looking at investing $5 billion in the next 4 years, the evaluation from the credit agency wouldn't be different for one of those.
No, they're going to look at the total investment. They're definitely going to look at the total investment. And what they're going to do is they're going to look at what is that investment? How is it going to be financed? How is it going to be funded? What are going to be the projected? They have a model they'll look at and say, this is what we project the various credit metrics to be based on the level of investment and the assumed financing plan that we provide them. And so if the capital investment went from 10 billion to 19 billion or 10 billion to 20 billion or whatever, and we said we're going to fund that all with debt, well, they would look at that very differently than if we said we're going to fund it with a portion of equity and a portion of debt. Yes.
Okay, so they're looking more at the structure of
maybe another way to get at it. If the total capital investment for Fiasco is 19 billion, and it was 9 billion electric and 9 billion natural gas, they wouldn't look at that necessarily as be all that focused on that split between the two, as long as they assume that the revenue recovery, the cost recovery is going to be consistent.
Okay, thank you. And you mentioned in your direct testimony that the provisions of Senate Bill 291 that shared gas volatility risk with consumers was viewed as negative by the credit agencies. Doesn't the state's concerted policies to move away from gas reduce those risks overall, particularly because of the positive impact on the electric side of the business? Or do the credit agencies, doubt the ability of the state to decarbonize, or what? How do they look at that dynamic?
Well, I was merely quoting the S&P report, and the S&P report said they viewed the bill that was passed as potentially credit negative because it allows for potential disallowance of costs and deferral of costs, which would affect the credit metrics. They're not opining on the policy of the state to decarbonize the gas sector.
But is there? I mean, I can see that component on the gas side. I'm just wondering if if the credit agencies see an associated benefit on the electric side, or do they not look at that?
Well, someone would have to be able to point out to them how they'd have to see that there is a benefit on the electric side. So in other words, even if there's a benefit on the electric side, if there's a natural gas PIM and there's a $25 million disallowance because natural gas prices rose, they would look at that and say, okay, well, there's $25 million that is not being collected from customers. It's no different than any kind of disallowance that occurs.
Okay.
And to the extent, if it's a small disallowance, then it's probably not going to have a material impact.
Okay. So they're not really looking at sort of the long-term policy implications on the gas system or the electric system. They're looking more at what's being allowed and what's not being allowed.
They're looking at, exactly, they're looking at what's going to drive credit metrics,
Okay.
what's
So
going to drive cash flow.
Okay. So one of the things that we've done in the past is we pick a whack and we have a range for the capital structure that the company can sort of move within. And I thought that was a sort of a good balance to protect the consumer and allow the company, that sort of flexibility to best manage their credit rating within the capital structure. But in this proceeding, the company is asking specifically not for a range. And I'm just if you could help me understand why that is, because I thought that helped the company manage their credit rating.
I mean, as far as whether there's a range, or at the end of the day, if the commission provides a range, we'll have to make a decision on where to operate. What essentially, we need to manage to a capital structure. And so if you provide us a range, we'll look at that range and determine what is the appropriate level we should manage to. So in the last proceeding, we decided to stay at the high end of the capital structure range. And the reason we did that is we think that provides the most protection for Piesco from a credit supportiveness standpoint. So in other words, if you give us a revenue requirement and we are at 55%, the credit metrics are going to be stronger than if we took that same revenue requirements and levered up the company and moved down to 52%. If we do that, the CFO or FFO to debt is going to go down because of that. And so we took the most conservative approach on capital structure based on that range. So if you give us a range, if the commission decides that a range is the appropriate way to manage it, we'll then have to look at that and say, what is the appropriate place within that range to essentially manage capital structure? And then the ROE essentially becomes a fallout from where the equity ratio is.
Yeah, I get that. What I was wondering is why in this proceeding, the company is asking specifically not for the commission to not give you a range.
I don't know that. I mean, I don't have a strong view on it one way or the other. At the end of the day, I just need an equity ratio that I can manage to. And so if the commission decides that they think that a range is more flexible, I don't have a concern with that.
Okay, thank you. And the last question, you mentioned that the credit agencies, when you have a disallowance of some kind of cost, that's a negative thing. Do they look at sort of the structure of the business? I would imagine, that there's a negative, and maybe this is wrong, but that they see because of the state's carbon goals, and this is a gas company, that there's a negative impact. But if the company were to expand their business to include capital investments that were not directly associated with gas, but for example, a clean heat sort of component of the company that was investing in heat pump systems or district heating or whatever it might be, some sort of clean heat, investment portfolio that would be then allowable expenses as opposed to disallowing, other expenses. Would that be seen by credit agencies as reducing risk to the company and in a clean heat sort of paradigm, of policy paradigm that we're in?
Yeah, they could look at that and say, that they see that this is a strong policy to reduce risk, and that if you look at another way to look at it is because we're a combined company, if there's a declining side of revenue and costs on the gas side that's offset by the electric side because of investment and returns, again, because they're looking at the consolidated entity, they'd say, well, this is fine. They don't see an issue. Obviously, if you had a standalone gas company that had a declining business and that reflect projected credit metrics that are going to decline, that's a different story. So what they're trying to do is interpret the actions of the company, the actions of the commission, the actions of the state to determine what that does to the company strategy, what the risks are for the company, and what the cash flows and credit metrics are a result of from that action.
Great, thank you very much, Mr. Johnson. I don't have any other questions.
Can you explain what that thing that looks like a guitar but has only 4 strings is?
It's a banjo guitar.
Okay, thank you very much. was hoping maybe you'd have a flying V instead, but that's cool too.
I appreciate your efforts, Mr. Johnson, to clarify the record on that point. Commissioner Gilman.
Good morning, Mr. Johnson.
Morning, Commissioner Gilman.
I had a couple questions for you related to something in your rebuttal testimony. We could or couldn't look at it. It's a fairly general concept. I think you'll follow without looking. In table PAJR1 in your rebuttal testimony, you showed the company's financial metrics for 2024 and 2025 under a range of different scenarios. Do you recall that?
Yes.
Okay, so in looking at this table, it looks as though the company's 2024 financial metrics are subject to a fairly sizable swing due to the outcomes of this rate case. Would you agree with that?
Yes.
And just to confirm, the credit analyses you conducted actually assumes the adjustments made in this rate case apply to the entirety of the public service entity, right?
Yeah, so what again it does is it assumes that the capital structure is going to be at the consolidated entity. The revenue is going to be based on whatever change in revenue there is from this gas rate case.
Okay.
So in other words, if the ROE is set at a certain level, that's going to inherently mean there's going to be a certain revenue requirement for this gas entity. That'll be the amount of revenue that'll be reflected. It doesn't look at the change in revenue for the electric. The electric revenue is essentially static based on the model.
Okay. So given that this rate case likely won't conclude until November 2024 or so, what's the basis for projecting such significant impacts to the 2024 financials?
It'd be really reflecting the change in the level of capital structure and the level of debt that would be existing in that entity.
And that's this impactful for only a portion of the entity for only 1/12 of the year?
Well, again, we did that earlier in the year, so you're looking at it at that point in time.
Sorry, walk me through that again.
So that was based on when that was filed at that point in time in 24. So if you change the capital structure at some point in time, what's the level of debt? What's the level of interest expense that's going to occur? I don't know the exact assumption for what the impact would be on 24 as far as when we would make the change in the capital structure. It's probably more important to look at the 25 metrics versus the 24.
Okay, so yeah, this was filed August 15th,
Okay.
2024. So then the 2024 projected impacts were based on as if the changes would occur the day you did the calculation, even though this rate.
I don't know the exact, I didn't do the calculation myself. I'd have to talk to our staff to find out what they assumed for when the capital structure was adjusted. But that's my assumption is why there's a impact. But again, I would be more focused on 25, which is more of a go forward credit metric.
Okay. And just to be clear, also the company's main request here is that these rate changes would go into a deferral, but then the actual changes would occur to customers in February 2025. Is that accurate?
Correct, with a surcharge back for the previous months.
Okay. Okay. Just one more question. Curious, you probably know that the history better than I do. I'm curious, going back the past 10 or 15 years, has there ever been an example where Public Service Company of Colorado has been downgraded based specifically on ROE determination in a rate case for the gas utility?
Well, I mean, I know that in the 2008 time period, the credit ratings for Piesco were lower than they are now. I don't know why what caused the rating agencies to make that adjustment. It is, again, it's not necessarily the ROE, it's going to be the impact on the credit metrics that flow through. That being said, the commission does look at decisions related to ROE and capital structure and cites those as in their reports as part of how they view the business risk for the entity.
Okay, so related to that, has there been an example in the last 10 or 15 years when the company has been downgraded based on the determination of ROE and credit and equity ratio for the gas utility specifically?
For Fiasco?
For PSCos, yeah, but like based on changes to the ROE and equity ratio for the gas utility specifically as it feeds into PSCO.
Not that I'm aware of.
Those are my only questions. Thank you.
Thank you, Commissioner Gellman. Hey, Mr. Johnson. Can we pull up table PAJ-R-1 from Mr. Johnson's rebuttal testimony at page 13? I just want to follow up on a conversation you've been having with my colleagues. So if you just look at scenario 1, which is basically what the credit metrics are with no rate case, it looks like you're more or less fine even with 0 rate increase. Is that a fair way of reading this?
Yes, strictly from a revenue credit metric standpoint, that if we didn't file a rate case, we would not be downgraded.
All right. And so I guess that's
I assume we would not be downgraded.
Right, and I get it would send a message to financial communities, changing regulatory environment, but at least on the cash flow credit metrics,
yes,
you'd be fine. And I guess that's at least some evidence that the way we set common equity ratios and ROE in the last case certainly didn't harm at least this aspect of the company's credit metrics. Is that fair?
Yes.
And just again, back to Commissioner Plant's question, as I understand it, the company's proposing ROEs in the 10s, other parties are in the 8s. It seems a little tough given that range to pick something down to like 1/100th of a basis point, or down to a single basis point. I've always thought that the range better reflects what's in this record. Do you have any thoughts or guidance on that? And to the extent a quarter somebody else is looking at it, that range accurately reflects the uncertainty in the regulatory process and the range of what we're getting presented. And any comments on that perspective?
No, I think that, again, as I mentioned earlier, I think that if you elect to pick a range of ROEs and equity ratios based on some weighted average cost of capital, I don't see a problem with that.
Okay, appreciate that.
As I said before, I mean, obviously, we're going to have to pick a point to manage to from a capital structure standpoint.
No, I appreciate that. And then you're picking the 9.2% ROE. We're not somehow imposing it.
We're not picking, basically it falls out from whatever equity ratio we pick. Correct.
Right. This may be a little bit beyond your testimony, but it came up with your discussions with Commissioner Plan, and Mr. Berman referred it to you. I had a discussion with Mr. Berman about public service companies' 5-year capital budgets, and more specifically, a March 2023 Xcel Energy investor presentation showed your 5-year capital budgets at $11.2 billion. About 14 months later, by April 2024, the proposed 5-year capital budget was now at $19.2 billion, a 70% increase that will maybe double or triple rate base from when I joined this commission. And given that Colorado retail electric sales have grown at a compound annual growth rate of 0.3% since 2010, can you provide us with any comfort that this capital spending plan is not going to produce large rate increases on the electric side in the coming years?
Well, I mean, I don't do the revenue requirement calculation or the customer bill impact. Obviously, the capital expenditure forecast that we include in our investor deck, we have a base capital forecast, and generally it includes projects that large projects are, have been approved by the commission. So the change for in Colorado really reflects the clean energy plan that was approved last fall. And that's why you see the adding more renewables, replacing coal generation, et cetera. That's reflecting of the capital, and the transmission are probably the biggest drivers in that change in that plan.
All right. And same question on the natural gas side. Given the likelihood of declining natural gas retail sales, should this commission be managing down natural gas spending to avoid rapidly rising rates on the gas side? And are there any things we should be thinking about in the financial community if we do go in that direction?
Well, I mean, I think that, we obviously want to do is want to make sure that we're operating the system safe and reliably. We obviously want to make sure that we're not making decisions that are going to put our customers or the public at harm, and we want to make sure we maintain that system. Obviously, any capital investments that we think that there's a potential stranded asset risk should be scrutinized both by the company and by the commission.
All right. Just moving on, the negative net salvage value. In your supplemental direct testimony at page 13, line 17, you say that the company is accruing $70 million per year in negative net salvage value, and that $400 million has been accrued so far. Is that fair?
That is correct. And I should point out that Art Friedis and his team are the ones that have come up with those numbers. Again, I'm not an expert on what we collect from our customers.
All right. And these accruals count as free cash flow that the company can use as it sees fit, including to support the credit metrics, increase dividends, whatever. It's your cash to spend as you see fit. Is that fair?
Well, I would say it's part of our operating cash flow, and it can be used to fund capital investment, pay for operating expenses, replace pipes, etc. That is correct. So we have an obligation based on that $400 million. We have an obligation to, at some point in time, make sure that we can fund the decommission that would occur at that, whatever that number is.
Your testimony goes on to talk about the potential damaging impact to the company's credit metrics if you were required to put that $70 million per year into a cash-based trust fund, or have to provide cash support for the $400 million that has been accrued so far. Is that fair?
I wouldn't say that I would call it damaging. And then maybe if you could advance to that schedule, we can just talk through that.
That'd be great. Do you recall the page number, or just have
it's a couple more pages, I believe.
Just let me know to stop when you see what you want.
I will let you know. Keep going. All right, here we go. No, keep going, keep going. All right, so this is the table. So what we tried, this is going to get a little bit nuanced, but the way it works is, let's say we collect $70 million from our customers. That'll be reflected in our cash from operations, okay? If we put $70 million into a trust fund, that would show up in the investing form of the cash flow statement, all right? So our CFO theoretically doesn't change. If the rating agencies recognize that and make an adjustment to it, what they would do is they'd back that $70 million up. So we basically have two different ways of looking at it, assuming the rating agencies make an adjustment or assuming that they don't. All right, so scenario one assumes that what happens is we issue $400 million worth of debt, put that into a trust, a decommissioning trust. And then we collect that $70 million from our customers annually, and we put that into the trust every year. So if in scenario one, what that assumes is that the the rating agencies adjust our cash from operations to reflect that $70 million being removed from cash from operations, and it also reflects that higher debt level. So that would say that the credit metrics would decline by 95 basis points. Scenario 2 is that we issue the debt of $400 million and we put that into a decommissioning trust, and the change there is that, and there's no change to the commission, or the rating agencies do not adjust cash from operations. So that would adjust the credit metrics down by 20 basis points, largely to reflect that there's really no change in cash from operations, but there is more debt outstanding. Scenario 3 is essentially that the $70 million that we collect from our customers goes into the trust fund every year. And the rating agencies notice that, and they adjust the cash from operations. And that would adjust the credit metrics by 80 basis points. And scenario 4 is that we establish that trust, we take the 70 million annually, we put it in the trust, but the rating agencies don't adjust cash from operations. They just reflect the fact that there is more debt on the balance sheet, because instead of having that $70 million available for, operations, we now have to fund that with debt.
And
so that kind of explains the various ramifications.
No, I appreciate that. That was very helpful. And do you have a view of how likely the agencies are likely the credit rating agencies are to adjust? I mean, it seems like what was free cash flow may now be restricted. But is it like 50-50 that they go from scenario 1 to 2 and scenario 3 to 4? Is it 20-80, or who knows?
I really couldn't venture a guess. It's I hate to bet on the credit rating agencies.
Fair enough. Are you generally familiar with the staff proposal to accelerate depreciation by 15 million per year, which I understand that the company does not oppose?
I have just a basic knowledge of it, yes.
All right. What would you think if we, in an order in this case, made it clear that we weren't requiring you to post credit support for the 400 million? That would stay as it was, but required the company to incrementally manage down that 70 million in annual net salvage value, salvage free cash flow to zero over, say, 5 years. And at the same time, offset that loss free cash flow to maintain credit ratios by accelerating depreciation on roughly a 1-for-1 basis. Would that essentially address this issue? So the idea is,
yes,
instead of taking 70 million out
I understand what you're saying, yeah.
You take 55 million and you'd accelerate depreciation, more broadly by 15 million. So no matter what we do with anything else in this rate case, I think that would keep you more or less even on a cash flow base, on a free cash flow basis, while potentially diffusing what could be described as sort of a time bomb of this negative net salvage value, and also accelerating depreciation so there was less hanging out there. So if the worry is, 30 years from now, there's going to be, greatly reduced gas sales, this removes the multi-billion, it basically funds the multi-billion or some portion of this in a trust fund. It accelerates depreciation and helps us both ways without hurting your credit metrics. So any reaction to that proposal?
I don't have any. I think that I think again, I think what you're saying is fair, and that would definitely address any credit metric issues. And if it addresses a concern that the commission has that there's a potential liability that would be difficult to fund in the future, that's a way to handle it. I mean, obviously, a decommissioning trust, there's some costs associated with it, but and there's some complexities, but that's something we can certainly manage through. So it's a policy decision that the commission can make, and it doesn't have the way you're talking about. I'm supportive of it.
And would you have any advice about how to best implement something like this approach in this case if we chose to do so? I assume it'd be language in the order, explicitly trying to manage to the concerns of the credit rating agencies.
Yeah, I mean, I don't have any specific advice for it. I think what you've talked about and proposed addresses any concerns that would occur.
I guess the one last thought. Is there a long-term letter of credit mechanism where the regulated system could pay a fraction of the 400 million per year and have a third party guarantee funding for the removal? I know in resource planning world, developers have to post credit support for the term of the offtake contracts, and the letter of credit costs were maybe 0.5% or 1%. Is there something like a similar approach to assure that there's funding for the 400 million or whatever that balance is at the end of the term? Again, the scenario is, we get out 30 years and there's no revenue and cash to, remove this. And I know we do it I've seen counties do it on decommissioning wind and solar facilities, right? They require a bond to be posted, and that, you pay a little bit every year, but at the end of the project life, the money's there to do this. So any thoughts or advice on something like that?
I don't have any experience with like a long-term letter of credit and that kind of arrangement. I mean, I guess the other thing I would assume is that we are going to be decommissioning a portion of the system over the next 25 years. I would expect that we would utilize that $400 million that we've got accrued as a liability to do that. So at 25, 30 years from now, hopefully that has been utilized from any lines that would be decommissioned. I guess the other alternative you could consider is issuing, having Piesco issue debt and take that $400 million and put it into a trust.
But that has real consequences.
Sure. Yeah, exactly. Because obviously then there's going to be an increase in rate base and the customers are going to pay the full whack with they're currently getting the benefit of. So there is a cost, yes.
Yeah, I mean, I was thinking if you could do a letter of credit, it might be a couple $1 million a year for 30 years, but then it's backstopped at no immediate cost.
Yeah, I guess we'd have to find an institution that would be willing to issue that letter of credit based on the credit supportiveness of Piesco.
Right.
I'm sure that there's many banks that would love to do that and would love to charge us for that.
I bet, especially if the electric business was standing behind it and it wasn't only the gas business.
Bankers always like to be helpful.
Yeah. I think that's all I have. Appreciate it, Mr. Johnson. Ms. Brahma, should we take a brief break and let you come back with a redirect, or are you ready?
That's fine. We can take a quick break now if it's a good time.
Yeah, why don't we break till 10:30 and then we'll come back with Ms. Brahma's redirect. Thanks. Ms. Brahma.
All right, thank you, commissioners. Mr. Johnson, I'd like to go back to some discussion you had throughout cross and discussion so far today regarding the credit metrics presented in your rebuttal testimony and potential changes to those credit metrics. First, can you explain whether the point of your rebuttal testimony is to focus on the exact point at which the company's credit ratings might be downgraded?
No, I mean, I think I think that we want to be very careful. We never want to have a company at the threshold of a downgrade. You always want to have some cushion for things that happen, particularly if you look at things like wildfire risk that we've seen in the past, that is now a much more prevalent thing. So I've always said, and I think in previous proceedings, I've said that a 200 to 300 basis point cushion is probably the right place to be, but you never want to be at that threshold.
Is there a single correct number for what the credit metric should be? Is 18.5 versus 18.6 or 19?
No, I mean, again, when you look at like we talk a lot about Moody's because Moody's has separate methodology for each entity of the Excel family, and each one has a standalone credit rating and based on their profile. The rating agencies will detail their methodology, but it is still a subjective rating, and they look at a lot of different things. And it's not like, hey, you're at 18.99%, therefore we're going to downgrade you. And so it is us making sure that we position the company to weather a storm and to preserve the credit rating so we can access the capital markets at attractive rates.
Okay, thank you. And at the same time, do you have enough information to speak about the likely investor reaction to a material reduction in the company's cap structure and equity ratio?
Well, Wednesday, I was in New York City at the Barclays conference, and we had, I think, 11 or 12 meetings, and every meeting the gas case came up, and the commission or the investors are continually focused on ROE and cap structure. We had a decision a year and a half ago in Minnesota where the investors thought that the commission was going to increase the ROE, and they didn't increase it to the level we did, and we lost 400 basis points of our equity value in 2 days. Clearly, our fixed income investors look at the credit metrics. They make an independent decision based on their assessment versus the rating agencies, and they look all at all of those things to determine what they think the appropriate credit spread should be for each one of the family members.
Counsel, I believe it was for UCA, asked you some questions about whether there was an immediate downgrade of public service after the 2022 rate case. And I think you were trying to give some examples of where things can go wrong after a adverse outcome, if you will. Yeah, and I think in particular, you started to refer to SPS. Could you please explain what happened to SPS when the New Mexico Commission reduced SPS's equity ratio to 51%?
Yeah, so I mean, the equity ratio had been approximately 54%. The New Mexico Commission, this was after the tax reform proposal had gone through, which affected some of the credit metrics. We had suggested that perhaps equity ratio should go up higher to offset the impact. The commission disagreed with us, and they reduced the equity ratio, and Moody's downgraded them relatively quickly and cited that as the reason for their downgrade.
What is the current equity ratio for SPS?
It is still 54.5%. And that's what's been authorized in previous rate cases. So they moved the equity ratio back up. However, the Moody's has not changed their credit rating for SPS. And so the lesson to remember is it's much easier to get downgraded than upgraded. And that, I would say, that's based on my 20 plus years of dealing with the rating agencies.
Was there also a time frame when public service companies' credit rating was down to BBB- at S&P?
Yes, as we talked about with Commissioner Gilman in the, we'll call it that 2005-8 time period, I believe that's when the credit rating was triple B minus. And again, as I was there, and it's never a good spot to be when you're on the verge of, when you've got no cushion to go below investment grade. And it took us a lot of time to get the credit ratings propped back up.
Was that situation part of the reason that the public service started with the commission's support to get its equity ratio at that time back up closer to 60%?
Yes, so at one point we had the equity ratio was at 60% to improve the credit metrics and also to reflect the fact that there was a fair amount of imputed debt from PPA contracts on the balance sheet. Well, off balance sheet, but reflected in the rating agency adjustments.
Okay. Thank you, Mr. Johnson. Could we please turn to we need Mr. Johnson's rebuttal testimony, hearing exhibit 126 at page 13.
A lot of focus on this schedule.
It's exactly what I was going to say. So one thing I think is important to make very clear, with respect to scenarios 6 and 7 in particular, do those scenarios, or to what extent do those scenarios reflect any of the adjustments staff and UCA proposed in this proceeding other than the different equity ratio and ROE that the company proposed?
It doesn't reflect any kind of additional adjustments or disallowances or lack of recovery. So if those were implemented, then the credit metrics would decline further.
So, for example, do these credit metrics reflect a 13-month average rate base?
No.
Do they reflect placing any money in a trust for decommissioning as opposed to having that available for the company's cash flow?
No.
Do they include any capital or O&M disallowances or lack of a return on assets?
No.
Okay. I just think that's very important because we talked a lot about the focus, as I understood it, was on these metrics without that. Was that what your understanding was as well, Mr. Johnson?
Yes.
So I'm trying to skip ahead a little bit here because I'd like to not have to jump around too much with respect to pulling up and down documents. So I'm going to switch gears a little bit. One of the questions I think that you were asked was if for 2024, when you provide both 2024 and 2025 metrics here, first of all, and maybe just to provide a little context, the company's proposed cap structure in this case is that based on year-end data as of the end of 2023?
No.
The equity ratio what was the company's equity ratio at the end of 2023?
Approximately 55.5, 55.6%, something like that.
Okay. And so if the company for 25 and then 24 was assuming only 2 months of data for revenues, but the cap structure taking effect for year end or different, would that have a material impact for 2024 in this assessment?
No.
Okay. You were also asked some questions here about the company needing to why, if the company was had no rate case filing, the credit metrics wouldn't change. Do you recall that discussion?
Well, I think we had a discussion on what the credit metrics, assuming no rate case.
I think that's a better characterization. Thank you. Following from that, are there reasons why public service needed to file a rate case apart from the credit metrics?
Yes, I mean, obviously there's costs that are being incurred that were not that are currently not being recovered. You know, clearly our earned ROE is significantly below what's authorized. Yes, these are legitimate, prudently incurred costs that should be recovered and reflected in our rates. And
do you have a sense of what the likely rating agency reaction would be if the outcome in this case didn't reflect, materially reflect, substantially reflect the investments that the company has made since its last rate case?
Well, I think I talked a little bit about this. I mean, obviously, all three agencies and also fixed income and equity investors look at material regulatory decisions, particularly in a company like Piesco, which is very important to the overall company. And they look at that and they make an assessment on the supportiveness of the regulatory environment and how that should impact the credit profile of the business risk, the financial risk, et cetera. And so a materially adverse impact would be reflected by investors and probably result in increased cost of capital.
And is that a concern to customers as well, to the company?
Well, I think it should be, because obviously it would increase the cost of financing for the investment that we have for Piesco. And Piesco obviously has a lot of investment that is going to be funding over the next 5 years.
Is it your understanding, or do you have an understanding whether customers also, or whether there's a benefit to customers to having a financially healthy utility?
Clearly there is. I mean, if you look at credit spreads, when investors feel that it's a well-run utility that is recovering its costs and has a supportive commission, you'll see a tighter credit spread, which means a lower cost of debt and more attractive equity that allows us to continue to fund capital investment and infuse equity into the operating companies.
Okay. Do you recall counsel for UCA asking you some questions about the extent to which a lower capital structure for the gas utility would have an impact on public service as a whole, given the higher authorized equity ratio for the electric utility?
Yes.
Now, UCA's proposal for a 51.4% equity ratio for the gas utility here, is that unique for the UCA to propose that kind of equity ratio in this gas case?
No, and matter of fact, they've made the similar recommendation for the electric. The only difference is that they use the rationale in the gas recommendation saying it's only a small portion of the business, therefore you shouldn't be concerned. But they make basically the same recommendation with electric. They're just being a little disingenuous about it.
Okay. I'd like to turn to the discussion you had with UCA counsel about the cost of long-term debt. So I think we can take down this document now. Thank you. With respect to the company's April 2024 update to the cost of its long-term debt, has the company routinely provided updates to its long-term debt in rate cases to reflect issuances that occur over sometimes the nearly year-long process between the filing of the case and the outcome of the case?
Yes, and historically, what you've seen over the last 5 to 10 years is that as interest rates have come down, the average cost of debt has declined. And so we've updated that newer cost of capital or newer cost of debt, and that has reflected a customer benefit. But we've made sure that we've incorporated that into the rate proceeding so that it's an accurate assessment of the cost for the customers.
So I referenced earlier the April update. Was that update also communicated to staff and UCA around that time?
Yes.
Did staff or UCA speak to one way or the other whether or not that cost of debt should be accepted or rejected in this proceeding?
In reviewing the discovery request, I don't recall anything having to do with that.
And how about in reviewing answer testimony?
No, I didn't see any assessment of that.
And to your knowledge, has there been a prior case where that similar type of update has been rejected?
No.
Now, I do apologize. I'm going to ask if we could pull up hearing exhibit 126 again, same one we just had, but at page 29. So on line 8 of your rebuttal testimony, Mr. Johnson, you characterize this update to the cost of long-term debt as a known and measurable adjustment. Do you see that?
Yes.
How is this a known adjustment? If you could explain what you mean factually by known and measurable.
Well, I mean, we've issued the debt. It's the actual cost of the debt. So it is, it is an actual number that is reflective of the debt that we issued at that time.
And when you issue a new bond, in this case, a 10-year bond, does that also mean that that cost change will affect the company over the life of that bond absent refinancing?
Yes.
And Mr. Bunker, I believe, asked you some questions about short-term debt. And do you recall that discussion?
Yes.
So why is short-term debt currently at a higher rate than long-term debt, generally speaking, in the marketplace?
It reflects the concern, as we talked a little bit, there's an inverted curve. That inversion is starting to go away over time, but it just reflects concerns that there could be a potential recession. And as a result of that, what you see is a higher short-term debt cost versus a higher long-term debt cost. And that's been the way it has been. It's been that way for, I would suppose, close to a year and a half or 2 years.
Okay. And is there a difference between what the company is proposing with respect to its specific change in the cost of long-term debt and whether short-term debt changes in the marketplace are similarly known and measurable?
So the change in short-term debt, I mean, obviously it can change every day. Would be a forecast. It's not known and measurable. What we try to do is provide I know that the forward test years and forward forecasts and things like that are not necessarily looked at positively here. So we use the historic test year, so the short-term debt that's reflected in the cost of service is the actual cost of debt that we had for 23, no different than the cost of O&M or anything else.
What did UCA propose with respect to short-term debt in this proceeding?
1%.
Do you consider that to be a better measure or more representative of the company's cost of short-term debt? In relation to the test year?
We have no ability to borrow at 1% in the current marketplace. We've not had that ability in 24. We don't have it we didn't have it in 23. We don't have it in 24. I'd be highly skeptical that we will see it in 25 and 26. It's a possibility, but it's certainly not anywhere available in the marketplace. If it was available, we certainly would take advantage of it.
Okay, thank you. I'd like to talk a little bit about UCA Exhibit 509, if we could pull that up, please. Okay, so as we discussed, or I discussed with the chair, and I think as you discussed from a factual perspective, the company had several concerns about the hypothetical assumed in this request. Just again, to talk about it a little bit, could you please explain from your perspective why this isn't a legitimate hypothetical, factually speaking?
Well, I think there's a couple things. Number one, and there were several data requests associated with this where there's some different scenarios. They asked us to run different scenarios, assuming a different capital structure and keeping so changing the capital structure, but not changing net income. And obviously, if you change the capital structure and incur incremental debt, there's going to be interest expense, but they asked us not to reflect that. So there were several discovery requests that were said, do this kind of math and give us the results. I'm not quite sure why they just didn't do the math themselves and say, here's what we see. So we did the math as requested. We don't agree with any of the assessments or the outcome of it. Again, you could theoretically come up with a allocated cap structure, and that's certainly an alternative, but we didn't. Essentially, they asked us to do a high level, just adjust the impact based on this, and it's not, I don't think it was a fully substantiated analysis that we would support.
Okay, if we could please scroll down to the last page, I believe it is, of this response. Oh, I'm sorry, of the narrative response. It would be page 2 of the, sorry about that. Oh, it is still page 1. Okay, so was there originally a response to this? Do you know, Mr. Johnson?
Well, I mean, I believe we objected to it, if that's what you mean.
Yes, that is what I mean. Thank you. And did, you mentioned that UCA potentially had the ability to do this themselves. Why do you say that?
It's just doing back of the envelope analysis. So, I mean, they should have been able to do it themselves.
And you also mentioned that UCA asked several hypotheticals. Was this just one example of those?
Yes.
And did you nonetheless, after the objecting and UCA coming back and asking for a supplemental response, what did your team do?
We responded.
Okay, thank you very much. And I guess I should ask too, to what extent did your team have to commit time and resources in order to do this math on behalf of UCA?
I mean, we have several people that spend a fair amount of time responding to data requests, and it's just another part of their job and requires time and effort.
Okay. I think we can, I'd like to just go to, I believe it was, I apologize, I was trying to take notes as we went along here, but could we scroll down to page 2? No, I guess it'll be 3. There we are. Just focusing your attention very quickly in the middle column here, Mr. Johnson, where it's talking about the debt to total capitalization ratio. Just one quick point of clarification. Where it talks about public service or PSCO in 2023 and 2022 at debt to total capitalization ratios of 44.8 versus 44.0. How is a debt to total capitalization ratio different than the equity ratio that we've been talking about in the 55% range?
Well, you would just take, I mean, if the equity ratio is 55%, then the debt ratio is going to be 45%. So
thank you. Yeah, I just wanted to clarify that we were not suggesting this was the equity ratio in this time frame.
No, it's not.
Yep. Okay.
The math all works.
Yes, thank you. We can take this response or this discovery response down now. So I'd like to talk a little bit about the question about a range of ROE and capital structures within a WAC, just again, very briefly. Are there reasons why the company would need at least certain components of the WAC to be identified as a specific data point rather than a range?
There are other aspects of the rate making process, and Art Friedis could provide more detail on what he would need. But clearly we need to have a cost of debt identified, and then for things like AFUDC, we'd have to have an ROE that we could use to calculate AFUDC going forward. But Art is probably the better person to ask regarding that. I was merely commented on from a management of the capital structure. We can certainly handle a range.
Okay, thank you. And do you have any concerns about whether it matters to the company if the ROE and cap structure ranges are capable of being met on either end within a WAC established by the commission?
Well, mathematically, yes, it should be a range that actually works. So if you have a 55% equity ratio, then the ROE that is at the bottom of the ROE range should be, you should be able to do that mathematically, that they fit within the range.
Thank you. And I think last topic here, the discussion you had with our chair regarding how you might manage the 70 million versus in a trust over time, or how you might dedicate that. Can you just address briefly how that would affect the revenue requirement if you're able to over 5 years?
Well, there'd have to be some way to adjust the revenue requirements to actually have that cash flow come in. So in other words, if you're going to stagger in a higher depreciation rate over time, then there would need to be some adjustment to the revenue over time to reflect that. Otherwise, the credit metrics would not have the benefit of that depreciation.
So by a mechanism do you mean something like a GRSA or just some other way to actually make the change to the company's
Yeah, I
revenue?
mean, there could be some step measure or some kind of regulatory mechanism, whether it's a rate case or some kind of step increase to reflect the higher depreciation. So if you increase depreciation from 15 million to $30 million, you'd want to reflect that in the revenue that the company's actually collecting. And obviously from an earnings standpoint, it'd be neutral, but it would affect the cash flows.
Okay. And I assume you don't take a position on how or if that would affect the company's costs of removal or availability of funds from a decommissioning standpoint in your testimony.
That's out of my knowledge sphere.
Okay, if I could just have one moment, I'm just going to check my notes, but I believe I'm done. I think so. Thank you very much, Mr. Johnson. I appreciate it.
Thank you.
I think we're calling thank you, Mr. Johnson. You're excused. I think we're calling Mr. Deslich next. Is that right?
Deslich. Thank you.
Deslich. Mr. Deslich, can you hold up your right hand?
Yes,
Do you swear to tell the truth, the whole truth, and nothing but the truth?
I do.
You can put your hand down. Is anybody in the room with you or communicating with you in any way?
No,
If that changes, you'll let us know.
I will.
Back to you, Ms. Herring.
Just want to check and make sure that the volume is okay on my.
It's okay.
Good.
Thanks.
Great. Mr. Deslich, can you please state and spell your name for the record?
Michael Deslich, Michael Deslich.
And by whom are you employed and in what position?
XL Energy Services, Inc., and I'm a senior compensation consultant.
And did you prepare direct testimony and attachments in this proceeding that have been pre-marked as hearing exhibit 108?
That is correct.
And did you also prepare rebuttal testimony in this proceeding that has been marked as hearing exhibit 129?
That is also correct.
Do you have any corrections to either of those testimonies or attachments?
I do not at this time.
Mr. Deslich is available for cross-examination.
UCA, I have 45 minutes. Mr. Bunker.
Yes, thank you, Mr. Chairman, and good morning, Mr. Deslich.
Morning, Mr. Bunker.
We have not met, but my name is Greg Bunker, and I represent the UCA in this proceeding. And to the extent you see me glance to my right, I'm looking at another screen, so I am paying attention to what you're saying, but I'm just looking at some notes on a different computer screen.
Sure thing.
All right, let's start with your rebuttal testimony, hearing exhibit 129. And at page 5 on lines 2 through 16, when we get there, on lines 2 through 16 there on page 5, here you indicate the purpose of your rebuttal testimony is to respond to UCA and staff answer testimony challenging 4 categories of compensation and benefit expenses, which you list in bullet points on lines 11 through 16. Is that right?
That is correct.
And if we could turn to page 9 of your rebuttal testimony, here you provide your recommendations as to these various points. Is that correct?
That is correct.
Okay, and if we could refer to the first bullet point item there on page 9, lines 2 to 4. This is your recommendation that the commission should allow recovery of annual incentive program, or AIP, at the target level. Is that right?
That is correct.
And on lines 5 through 8, you indicate that Piesco is seeking a 2024 AIP target level. Is that right?
That is correct.
And 100% performance level is that AIP target level you're referring to. Is that right?
Correct.
Okay. Now, if we could go to Mr. Fernandez's answer testimony, which is hearing exhibit 501, page 117, please. Again, that was hearing exhibit 501, page 117.
Yeah, sorry, it just takes a while to scroll that far down on the spreadsheet, so.
Yep. I understand. Not a problem. Thank you. And if we could enlarge that maybe just a touch. Oh, that's great. Thank you. On lines 1 through 3, Mr. Fernandez indicates that Piesco is seeking AIP target level expenses of $5.3 million, assuming the 100% target incentive amount at the individual level. Is that right?
That is correct.
And you've indicated in your testimony, and we don't necessarily have to go back because I think you'll be able to answer this. Both staff and the UCA recommend a 15% cap on AIP expenses per employee. Is that correct?
That is correct.
Okay. And on Mr. Fernandez's testimony here on page 117, lines 4 through 20, Mr. Fernandez cites numerous recent Colorado gas and electric cases and a case for Black Hills in Colorado and an electric and gas rate cases in another XL jurisdiction, NSPM Minnesota Electric and NSPM Minnesota Gas, which all limited recovery of AIP expenses to 15%. Do you agree with that?
In those particular situations, that is correct.
Okay. Now, turning to page 10 of your rebuttal testimony, which is Exhibit 129. Excuse me. On lines 10 through 14, you acknowledge the commission has previously imposed a 15% cap on AIP compensation in prior rate cases. Is that right?
Yes, and that started in approximately 2017.
Okay. And you indicate on line 17 there's no substantive support in this case for continuation of the cap. Is that right?
That is correct. There hasn't been any market-based information that's been provided to identify the fact that a 15% cap across all employees that are eligible for annual incentive, that cap should be applied to each and every person and every job.
Okay. And turning to page 11 of your testimony, you indicate the 2023 Willis Towers Watson compensation study supports Piesco's argument that the 2024 AIP target level expense should be approved. Is that right?
The Willis Towers Watson study makes a comparison between what the company supplied to Willis Towers Watson in the 2023, or excuse me, probably the 2022 data, and this particular study was published in 23. And it compared the compensation levels of base pay, annual incentive, and long-term incentive to a particular group of utility companies across the nation, and found that we were at or slightly below the levels of the utility organizations across the country.
Okay, thank you. And is it correct that XL Energy retained and paid Willis Towers Watson to create the 2023 Willis Towers Watson compensation study that supports your argument about the 2024 AIP target level?
Willis Towers Watson was asked to provide this study to us, and for that service, we did compensate them for that product.
Okay, thank you. If we could look at your direct testimony, hearing exhibit 108, and in particular, your attachment NPD 1.
Sorry, I heard you. It's my screen froze. Give me just a second. I know you're looking for 108 MPD one.
Yes, not a problem. Thank you.
Can you see it?
Yes, if you could scroll down just a little. I'm sorry. I didn't realize it was up on the screen. And this is the public version, which is fine. When I review this attachment NPD 1, I found no references to Piesco gas, Piesco, or even Colorado in this Willis Towers Watson compensation study, and only references to Xcel Energy. Would you agree with that?
I would agree with that because the company sponsors its compensation program across all entities of the company, including Piesco Gas and Electric.
Okay, thank you. So on page, let's skip for a moment to Mr. Fernandez's answer testimony. It's Exhibit 501 on page 118. On lines 1 through 9, Mr. Fernandez states the UCA's recommendation that the commission continue its fair and consistent treatment of incentive compensation by capping Piesco's AIP incentive compensation at 15% per employee in this proceeding. Do you see that?
I do.
And the estimated amount of the AIP compensation is listed there on line 6. The AIP incentive compensation and its revenue requirement above the 15% employee level is $636,396. Is that right?
That's correct.
Okay. And Mr. Fernandez indicates this adjustment is included in the UCA's revenue requirement model attachment RAF2 there on line 6 and 7, right?
I'll take your word for it that it's in there. Yeah.
Okay, thank you. If we could now move back to your rebuttal testimony, Exhibit 129, and I'd like to talk about environmental long-term incentives, or the LTI, and the time-based long-term incentive compensation, LTI. I'd like to talk about that collectively if we could. And if we could turn to page 9 of your rebuttal testimony, you'll see those two items starting at line 5 through line 19. So your second bullet point, here you contend the commission should allow recovery of environmental LTI at the target level, right?
That's correct.
And if we could go to page 26 of your rebuttal testimony, here you indicate that in responding to UCA and staff recommendations, that the commission should disallow the entire the UCA and staff recommend that there should be a disallowance of the entire expense associated with the target amount of Public Services environmental LTI compensation. Is that right?
That's correct.
And going back to page 9 for a moment, your third bullet point. This is the bullet point where you contend the commission should allow recovery of time-based LTI at the target level, correct?
That is correct.
And skipping forward to page 31 of your testimony, here you're responding to UCA and staff recommendations on lines 13 through 18, and their recommendation that there should be a disallowance of the entire expense associated with time-based LTI compensation. Is that right?
Can you scroll up just a moment? Oh, sorry, scroll down into that section. I believe that's correct. Yes.
Yeah, I'm referring to the heading B at the bottom on line 13 and that question and answer through line 18.
Yes.
Yes, all right. And if we could go to Mr. Fernandez's answer testimony, Exhibit 501 on page 118 and at lines 15 to 21. Would you agree Mr. Fernandez states several objections to the recovery of environmental LTI and time-based incentives?
That is correct.
And the several objections at lines 15 to 21 include that the environmental LTI and time-based incentive programs are poorly designed and duplicative, correct?
That is what Mr. Fernandez stated. Correct.
Yes. And multiple commission orders and settlement agreements in Piesco rate cases have denied recovery of LTI expense from ratepayers. And that all LTI costs are more appropriately assigned to shareholders. Do you see those two items?
I do see that.
Yeah. If we could turn to page 120 of Mr. Fernandez's testimony. On line 1, Mr. Fernandez opines that ratepayers receive no benefits from environmental LTI compensation. Is that right?
I do see that.
And on page 119, lines 1 through 5, do you agree that in the 2022 case, which is 24AL-0049G, which was Piesco's last gas rate case in 2022, that was a fully litigated case and the commission denied recovery of both time-based and environmental LTI?
That is correct.
And on lines 6 through 14, do you agree that in Piesco's last 3 phase 1 electric rate cases in 2022, 2021, and 2019, and whether they were fully litigated or due to a settlement, Piesco was denied or excluded in the case of a settlement from recovering LTI and compensation expenses?
Yes, that is correct.
And at page 120, starting on line 15 and continuing on to page 121 at line 2, and footnote 123, here Mr. Fernandez cites your direct testimony, table MPD-D-1, for Piesco's estimated amount of environmental LTI compensation included in the 2023 revenue requirement. And he notes that there should be an adjustment to exclude this environmental LTI compensation in the amount of $558,259. Is that correct?
That was the adjustment he had included, correct?
All right. Now, if we could talk about not environmental, executive compensation, sorry. And if we could go to your rebuttal testimony again on page 9, and this would be the fourth bullet point, starting on line 20 through 26. And here you advocate the commission should decline to adopt UCA's recommendation to disallow $1.6 million of executive compensation based on application of the Drucker compensation principle. Is that correct?
That's correct. This particular principle has never been employed at any level that I'm aware of across any particular industry, and I don't see why it should be applicable in this case.
Okay, let's go into that for a moment. Excuse me. On lines 22 and 24 here, you state the Drucker compensation principle provides that there should be a 20-to-1 ratio between compensation of a CEO and an average worker. Is that right?
Based on the information that was provided, that's correct.
Okay. And is it correct that one of your objections to applying to the Drucker compensation principle that you mentioned on lines 24 and 25 is that this compensation principle has not been adopted by any Fortune 500 company and would not result in market competitive compensation for employees? Is that right?
That's correct. And not only Fortune 500 companies, I couldn't find it applicable to any company anywhere when I tried searching on it.
Okay. When looking at, let's just focus on the Fortune 500 companies. When looking at Fortune 500 companies, how many are regulated utilities that enjoy a monopoly status?
I didn't count them specifically, but my guess is probably somewhere in the neighborhood of 25 to 40 as a guess, but I'm not certain.
Okay. And you indicate that you're not aware of the Drucker compensation principle ever being applied to executive compensation recovery for any regulated Colorado utility. Is that right?
I don't see it being applied to any company in any industry, including the utility industry, including Colorado.
Okay, let's look for a second at your rebuttal testimony on page 37. And specifically at lines 12 to 16, you indicate you're not aware of the Drucker compensation principle ever being applied to executive comp recovery for any of the regulated Colorado utilities. Is that right?
That's correct.
Okay. And would it also be accurate that you're unaware of any prohibition with respect to the commission's application of the Drucker compensation principle to the executive compensation recovery issue for any regulated Colorado utility?
Objection to the extent it calls for a legal conclusion.
Mr. Bunker, you want to respond?
Yeah, I believe that this witness is able to respond to this. He indicates it's never been applied, but the converse of that is he aware of any prohibition on applying it?
Yeah, I'll allow it. Overrule.
Can you restate the question, please?
Sure. Would it also be accurate that you're unaware of any prohibition with respect to the commission's application of the Drucker compensation principle to the executive compensation recovery issue for any regulated Colorado utility?
I'm not aware of any prohibition that the commission may have with regards to that particular theory that Mr. Drucker had 50 years ago.
All right, let's go to Mr. Fernandez's hearing exhibit 501, his answer testimony at page 126. And at lines 1 through 5, here, this testimony regards other Excel jurisdictions limiting recovery of excessive executive compensation. And would you agree in the most recent NSP Minnesota electric case, the Minnesota PUC capped customer expenses for Excel's 10 highest paid executives at $150,000 per year, in alignment with what the Minnesota's governor earns?
This particular ruling is actually under appeal at the moment, and I don't have a final outcome for that.
Do you agree, though, that in the decision itself from the commission, the Minnesota Commission, that they did cap compensation at $150,000 per year for executives?
That is what they indicated in the order, correct?
Okay, thank you. Now, going back to your rebuttal testimony at page 43, and this is hearing exhibit 129. At page 43 on lines 8 through 11, here you discuss this Minnesota electric rate case, and you say the MPUC's decision to limit executive compensation to the governor of Minnesota's salary of $150,000 was not based on a review of applicable salary market conditions, was not a recommendation from any intervening party, nor based on any record of evidence. Is that right?
That's correct.
And with similar to the Minnesota Commission, would you agree that with regard to rate case related executive compensation limitations, this Colorado Commission has the discretion and the rate making authority to limit the recovery of executive compensation?
Objection to the extent it calls for a legal conclusion.
Would you like to rephrase, Mr. Bunker?
Would you agree that the commission has discretion with regard to issues and adjustments in this rate case?
I believe the commission's responsibility is to look at just and reasonable expenses that the company incurs in the operation of its business to supply safe and reliable energy utility services to its customers.
Okay, thank you. Is it your understanding that Mr. Fernandez and the UCA are not recommending that Piesco and Excel should change its executive compensation, but rather the UCA is only making recommendations on who should pay for excessive executive compensation?
I'm not really sure that UCA or any intervening party has really identified what is considered to be excessive, because they have not supplied any market information that identifies where our company versus the market differ.
Well, didn't Mr. Fernandez recommend a Drucker principle requirement, or let's call it a provision, that would disallow compensation above the 20-to-1 ratio?
Again, that's not really something that's ever been employed across any organization across the country. And I don't see why it would be introduced at this time. And I believe it's only introduced to create some sort of adjustment to limit the company's recovery of regular expenses that are required to attract and retain employees and motivate them in the service of our customers.
Okay, let's turn to Mr. Fernandez's answer testimony on page 125. And we have his table RAF 19. And this identifies the 6 top executive salaries at Excel for 2023. Would you agree?
I agree.
And in the discussion just below the table, he indicates that the 20%, by taking the 20-to-1 ratio, the compensation is $27.4 million over that 20-to-1 ratio for the top 6 executives. Is that right?
In his particular example, it is, but I think there are a number of things that need to be considered here. While this is the information that he pulled from our proxy, this is not what the company has requested for rate recovery. So any adjustment that would need to be made should be based on what the company is actually requesting in this case. Or if you'd like to use the full amounts that are listed on this page, we could maybe work through that type of an adjustment to determine what they feel is accurate.
Okay. So looking at lines 6 through 8, just below this table, Mr. Fernandez indicates using an allocation factor of 5.8% provided by Piesco as an approximate allocator for Excel to Piesco gas. The Piesco gas excess compensation amount would be $1.6 million for the top 6 executives. Did I read that right?
Yes, but again, his calculation is based on information that has not been requested by the company.
You mean provided by the company?
The company has not submitted all compensation elements for its executives in this proceeding. And this particular table that he identifies includes all actual compensation received in 2023, but not the company's request, which is lower.
Okay, with that, I think I'll leave it there, and that ends my cross-examination, Mr. Deslich. Thank you.
Thank you, Mr. Brunker.
Thank you, Mr. Brunker. Commissioner Plant, any questions for Mr. Deslich?
I have no questions.
Commissioner Gilman?
Hi, good morning, Mr. Deslich.
Good morning, Commissioner.
Just wanted to talk to you briefly about 2 areas, vacant positions as well as executive compensation, to follow up on some of the discussions. So first, with regard to vacant positions, so as staff pointed out, Excel laid off quite a few employees and also offered voluntary retirement offers to several hundred last year. And I know you point out in your testimony that very few of those were actually at Public Service Gas, just one, I think, at Public Service Company Gas, and just a handful at Excel in the gas operation. But if I'm to kind of try and take the point to understand how this works after a rate case, if Public Service Companies gas operations slim down or cut employees, say, that doesn't change the revenue requirement going forward, right? The company will be awarded whatever it was based on whatever was submitted in this case.
I believe Mr. Freitas can talk to the specific revenue requirement. However, changes in headcount aren't all a one-for-one change. If we had one employee that left the company, they may have been at a certain level in the organization and a certain job at a certain pay, and we could have hired since then several other people in various jobs at even higher or lower levels of pay. So headcount isn't necessarily the best barometer to determine what the expenses should be. It's a starting point to indicate that, you know, there's a person in a job, that person receives pay and benefits. However, not all pay and benefits are the same for every person in every job.
Okay. So with the vacant positions, can you just talk me through kind of the details? So these are positions the company already has posted or plans to post, within what time frame?
Positions are posted on a daily basis and are filled on a daily to weekly basis. It's hard to really say at any given point in time. I do know that the expenses for our gas side of the business here in Piesco, it was identified in my rebuttal testimony. Those expenses had gone up in the first 6 months of 2024, higher than both the 6-month periods in the first half of 2023 and the latter half of 2023. So
Okay.
headcounts, again, don't necessarily mean that there should be some type of an adjustment out for a specific headcount, because as I mentioned, other employees are being hired throughout the year on a regular basis, and their pay and benefits could be slightly different.
Okay, so understanding this happens kind of on a rolling basis, what's the basis for the assumption in the vacant value that should be included in rate base per your argument?
Again, I believe Mr. Freitas can speak to that a little bit more, but the way my understanding he approached it was whatever expenses were there, actual expenses were included. If a position was vacant for a period of time, those expenses obviously aren't there because there isn't an employee to attach them to, so therefore they would not be included. But then as new employees come on throughout a period of time, those expenses would be included up to the point where the filing took place.
Okay. Sorry, I'm a little confused. Is the company proposing to include in the revenue requirement a value for positions that are currently vacant as of, positions that were filled as part of the historic test year?
Again, I don't believe it's based on a vacant position. It's based on the expense that was accrued during that period of time or incurred. And again, Mr. Freitas has greater detail into adjustments and what's included in the revenue requirement.
Okay.
And that accounting detail.
Okay. I just want to understand something that was presented in one of your attachments. Attachment MPD 11. I think sorry, let me get that hearing exhibit number. Probably hearing exhibit 129, MPD 11. Shows kind of a comparison of it says CEO compensation based on 2024 Excel Energy proxy statement. And you kind of contrast total compensation here with something from public service from calculation UCA. Can you describe to me your calculation showing total compensation, what this is intending to show?
Sure. In the table that Mr. Bunker pulled up from Mr. Fernandez's testimony, he included all compensation for the CEO, and I limited it to that single person just to make things easier. And you can see in that total compensation line, $21 million was total actual compensation. However, the company in its request would limit that based on the fact that we do remove the relative TSR compensation, which is relative total shareholder return portion of the LTI payment, as well as any payment that was above target for both annual incentive and either the environmental and long-term, or excuse me, the time-based LTI.
Okay, so in what's presented in the furthest right column here, does that represent what the company is requesting as treatment in this proceeding, or what the past treatment has been determined to be for these incentives?
This is what the company would be requesting. And again, this is a very simple example to just compare what UCA was looking at in creating some level of an adjustment to what is something closer to what the company would be requesting.
Okay. Okay. Let me see. Are you aware, just generally, that the commissions received significant comments regarding the level of compensation for executives at Excel and Public Service Company?
I'm not aware of those comments.
Okay. Those are my only questions. Thank you.
Thank you, Commissioner Goman. I have no questions for Mr. Deslich. Ms. Herring, any redirect?
Yes, just briefly. Mr. Deslich, do you remember UCA counsel asking you questions about the Willis Towers Watson study performed by the company?
Yes, I do.
Are the costs of the Willis Towers Watson study being included for recovery in this case?
No, they are not. The company had that study prepared for other jurisdictions, and those costs are not included in our request for rate recovery in this case.
Mr. Deslich, do you recall UCA counsel asking you about previous commission decisions limiting the recovery of API and LTI?
I do. AIP, yes.
Sorry. Given those prior decisions, why is the company requesting recovery of target levels of AIP and environmental and time-based LTI in this case?
Sure. The company uses a market-based approach, and it looks at all compensation and what's comparable out in the marketplace for design of its compensation programs. So each position that it benchmarks to the marketplace, we look at base pay, annual incentive for those that are eligible, as well as LTI, long-term incentive for those that are eligible for that form of compensation. And the company's programs are then based on goals that are established for the incentives, what the company feels it needs to work on internally or to help serve customers better. Our AIP program has a limited number of goals that are identified on our corporate scorecard. And each year, those scorecard results are published. And the AIP payment, if one is justified, would be paid to the employees based on that outcome. As far as our long-term incentive program goes, there are 3 different components that impact our business unit vice president level employees and above. Those would be the relative TSR component of LTI, which the company is not requesting for recovery, the environmental portion of LTI, which is our carbon reduction goal for the company. And again, this is something that the company feels strongly about, and as the goal or as the type of compensation indicates, long-term incentive covers an extended period of time. And in this case, getting to that carbon reduction goal to reach our carbon-free goals by 2050 is an extensively long period of time. And the reason the company has placed that into the LTI program, it's so the leadership of the organization has some level of consistent skin in the game, as they would say, that their pay is being put on the line to continuously make progress towards that long-term goal. Because if they didn't, we wouldn't be able to reach that goal. I think, goals that aren't written don't always get the same level of focus. However, that doesn't mean that other goals aren't behind the scenes that are getting focus. But when you put the employee's compensation at risk in this case, it does create a greater level of focus and marching towards that, again, long-term goal. And then our time-based LTI is something that creates longevity of our leadership and those that are eligible by creating a retention tool for deferred compensation.
And Mr. Deslich, talking about the total compensation amounts that the company is requesting recovery for in this case, how does the company go about determining what the total compensation should be for its employees?
Sure. Again, it looks at third-party independent benchmark studies. We provide data to these companies, as do companies across the United States. The Willis Towers Watson study itself reviewed utility companies, and in particular looked at ones that were in a comparable revenue space with Xcel Energy and made a comparison. And in both comparisons, both on the utility that are the same revenue level and the national level, Xcel Energy is very comparable at at each level, but slightly below at that revenue cut for base pay, annual incentive, and long-term incentive. So in making that comparison to the market, we are just slightly below, which would indicate that we are not paying excessive levels of compensation across our company.
And Mr. Deslich, turning to the Drucker principle, you testified in response to UCA's question that you've never seen this principle applied in any company. Is that correct?
That's correct.
What is the best practice for determining executive compensation?
Market-based levels of compensation, looking at comparable jobs, comparable industries, comparable size of the organization, revenues, those types of things are all included.
And one last question. Commissioner Gilman had a question for you about vacant positions. Do you recall that?
I do.
And to your knowledge, is the revenue requirement that the company has in this case, is that based on a particular head count?
It is not. It was based on actual expenses.
I have nothing further for this witness.
Thank you. You may be excused, Mr. Deslich.
Thank you, Commissioner.
Mr. Chairman, if I could.
Yeah.
I note that I had 15 minutes left on my estimate for Mr. Deslich, and he and I think it was Mr. Johnson have referred several issues to Mr. Freitas in response to either my questions or commission questions, and I would like to take that 15 minutes and move it to Mr. Freitas, if I could.
All right.
Thank you.
Thank you, Mr. Deslich.
Thank you, Chair Blank.
Let's go to Ms. Gilliland. Can you hold up your right hand? Do you swear to tell the truth, the whole truth, and nothing but the truth?
I do.
You can put your hand down. Is anyone in the room with you or communicating with you in any way?
No, they are not.
If that changes, you'll let us know.
Will do.
Back to you, Ms. Samard Pacheco.
Thank you, Chair. Well, let's see. It's still good morning, Ms. Gilliland. Could you please spell your name for the record?
Sure. Lauren Gilliland, LAURENGILLILAND.
Thank you. By whom are you employed and in what capacity?
I'm employed by Xcel Energy Services, and my title is Vice President, Gas Operations and Engineering.
For purposes of this case, did you prepare hearing Exhibit 104 as your direct testimony and hearing Exhibit 127 Rev 1 as your rebuttal testimony?
Yes, I did.
Do you have any further corrections to your rebuttal testimony?
Yes, I do.
Could we please pull up hearing Exhibit 127 Rev 2 from the company's box? And once we do that, could we please go to page 29? Line 12 and 13. Ms. Gilliland, can you please explain the corrections being made?
Yes, as you can see, the total number amount of 4.5 million should have reflected 5.4 million. And as you can see, instead of discussed below, it should actually be above.
Thank you. With those corrections, the company moves for admission of hearing Exhibit 127 Rev 2.
Any objections? Hearing none, so moved.
Ms. Gilliland is now available for cross-examination.
Staff has 20 minutes.
Yeah, thank you, Chair. Before I get started, I just wanted to let you and the parties know that we are going to waive our cross of company witness Amen.
Okay, thank you.
Yep. Get my notes up. Good morning, Ms. Gilliland. My name is Katie McLaughlin, and I represent staff in this proceeding. I have just one main topic to discuss with you today. Hopefully we'll finish up in less than 20 minutes. But I want to talk to you about the company's Gas Quality Service Plan, or QSP metrics. In general, the QSP measures the company's gas service to customers with various metrics.
I would agree, yes.
Okay. And one of those metrics is the repair time for a grade 2 leak, correct?
Correct.
And would you agree that a grade 2 leak is generally considered a leak that is non-hazardous at the time of detection, but could become hazardous in the future?
Yes, I would agree with that.
And in your rebuttal testimony, the company proposes to reduce the average repair time for a grade 2 leak from 52 days to 40 days, correct?
That's correct.
And you recall that staff recommended that the company set the average grade 2 leak repair goal at 28 days.
Yes, I do recall that, correct.
And in 2023, isn't it true that the company averaged a grade 2 leak repair time of 25.9 days?
Yes, that is correct.
Now, isn't the company directly accountable to the Pipeline and Hazardous Materials Safety Administration, also known as PHMSA?
Yes, we are.
So the company has to comply with all applicable PHMSA laws and regulations?
Yes, that are put into rulemaking, yes.
Okay. And if PHMSA updated its regulations, would the company have to comply with those new rules?
Yes, we would.
Okay. I just have some brief questions for you. Is a gas rate case the only proceeding in which the company's gas QSP could be modified?
I believe so, yes.
It couldn't be done in a standalone proceeding?
I would object to the extent you're asking her about regulatory process, which is beyond her area of expertise. Perhaps you could rephrase the question.
You can rephrase, but I think the witness, if she doesn't know, can say so. So if you just rephrase, that'd be great.
Absolutely. Are you aware of a QSP ever being brought in a standalone proceeding?
No, I am not aware of that.
Okay. So if the company has brought a standalone proceeding in the electric QSP, would you have any reason to dispute that?
I would not have any reason to dispute it, no.
And you don't know of anything that would prevent the gas QSP from being in a standalone proceeding, right?
The only recollection I have is during the gas rate case proceedings that we've done QSPs for gas.
Okay, but you don't know of anything that would prevent the company from bringing a gas QSP in a standalone proceeding?
Not that I'm aware of, no.
Okay. So I recognize that the electric and the gas systems are very different, obviously, but do you believe that there are some lessons that parties could learn from comparing the electric QSP to the gas QSP?
As I'm not familiar with the electric QSP, I wouldn't agree of knowing the similarities between the two comparisons, but always up for discussion of a review.
Okay, absolutely. The electric QSP used granular data on census block groups in its metrics. Do you have any reason to dispute that?
No, I do not.
And are you aware that the commission has a statutory obligation to consider disproportionately impacted communities in its decision-making?
Yes, I do.
Okay. And that's in all of the commission's work?
I would assume so, yes.
Okay. Now, the impact of service quality to DI communities can't really be assessed unless granular data is used to understand the community impacts. Would you agree with that?
If the data is available to provide, yes.
Okay. And couldn't the gas QSP be improved by using such granular data for certain metrics?
I would say it's always open for discussion of looking at that, but all of our leak grading, especially the grade 2, it doesn't have any recollection or determination of the areas of impact. It has to be dealt with the exact same way, depending on the severity of the leak.
Sure, but beyond the grade 2 leaks, the QSP addresses other metrics, right?
Correct, yep.
Okay, so the census block on granular data could be impactful for those other metrics as well.
Potentially, however, those other two metrics within
Okay.
the QSP also have certain rules that have to be followed regardless of, impacted communities as well.
Sure. Now, did the company propose a metric around service inequality by census block group in its gas QSP here?
No,
Has the company considered this possibility?
not at this time, no.
Do you think that if the commission heard the gas QSP in its own proceeding, more time and attention could be provided to it compared to including it in a rate case?
Again, there's always open for discussion of evaluating the additional, data that could be available dependent on what that would look like for further evaluation.
Do you think that putting it in its own proceeding would give it more time and attention?
I would say there definitely would have to be more discussion involved of what data is currently available or what would be proposed outside of this proceeding, yes.
Okay. And do you think that such a standalone proceeding would help the commission to more robustly consider the quality of service for DI communities to address some historical inequities?
I would say potentially, however, the current QSP metrics that we have really don't have a comparison with those types of communities, as we have an obligation to meet those metrics based off of the current criteria from our state and federal regulations.
But it's possible that it could include additional information.
It could, depending on what it actually is needed and how it actually reflects the impact.
Okay, great. Ms. Gilliland, that's all that I have for you today. I really appreciate you answering my questions.
Okay, thank you.
Thank you, Ms. McLaughlin. Let's see, UCA, I have 50 minutes for you, Ms. Singer Nelson, and maybe we'll take a break at 12:15 if there's a logical break.
Okay, it might be easier to take the break now. And if that works, okay, Mr. Chairman.
Yeah, let's do that. So it's 11:53. Let's come back at 12:30 since we've got an early ending today. So 12:30.
Works
Thanks.
great.
Ms. Singer Nelson, you're up.
All right, thank you, Chairman Blank. Ms. Gilliland, my name is Michelle Singer Nelson, and I'm an attorney for the Utility Consumer Advocate Office here in Colorado. Good afternoon.
Good afternoon.
Your testimony addresses operations and maintenance expenses for liquefied natural gas, otherwise referred to as LNG, and compressed natural gas, otherwise referred to as CNG. Is that correct?
That is correct, yes.
Are you aware of this commission's affordability initiative work plan, where the commission states that affordability is a critical part of the commission's oversight as it regulates Colorado gas and electric utilities?
I'm not specifically familiar with that verbiage, but assume that's part of their plan, yes.
Okay. Just for your information. Oh, first of all, can you just tell us, I know there's different statements throughout your testimony that addresses the exact amount that public service is requesting for LNG and CNG procurement costs in rate base. Could you identify what the current number is for that?
Yeah, would you actually mind pulling up? I believe it's in my rebuttal testimony of the exact number, so I can confirm that.
Okay. Your rebuttal testimony is hearing exhibit 127. And are you referring to your table?
I'm assuming so, or whatever amount you're wanting for me to confirm would be great.
Okay, I think it's at, let's see. At page 24. There you go.
Yep, those are the accurate numbers that were in my rebuttal testimony, yes.
Okay, so the for LNG costs, your commodity requests are $119,138. Is that still included in this proceeding?
It's not included in the cost of service, no.
Okay, where is that amount been moved to?
It's not part of this proceeding.
Is it true that was moved to the GCA proceeding?
I believe so, yes. And Mr. Pette could add more additional context since he was part of that hearing.
Okay, so then is that true for the commodity costs relating to your GNC expenses?
The CNG?
Yeah, CNG.
Correct. All cost of service is not included in here as indicated on the right-hand side.
Okay, so in response to my question as to what the current amount is that the company is seeking to recover for procurement costs or third-party vendor support costs, as they're referred to in these tables, is the addition of $5,226,183 and $357,758. Is that right?
For the third-party vendor, correct.
Okay. Is the company looking for the amounts that are set out for materials in red in these two tables?
That is correct, yes.
Okay, so in order for all of us to determine exactly the amount that the company is looking to recover in base rates for LNG and CNG, we'd have to add the numbers in the last two rows of each of these tables. Is that right?
Yes, and I would believe that was part of the correction that we discussed earlier within my rebuttal testimony of the 5.4 million.
Okay, so it is a $5.4 million amount.
Correct.
Okay, good. Thank you.
Sure.
I'm going to start off by talking about you can take this down. Thank you. The historical use by public service of LNG. Public service first started using LNG in Breckenridge in the 22-23 winter heating season. Is that right?
That's correct.
And you then used LNG again for the 2023-2024 winter heating season?
That is correct.
Just as an aside, public services winter heating season runs from November 1st of one year through March 31st of the next year. Is that correct?
Roughly, those are the appropriate timelines, depending if we have some type of severe weather event. Yes.
Okay. So any particular use of LNG for a winter heating season would be in 2 separate calendar years, correct?
Potentially, yes.
Would you agree that LNG costs included in the calendar year 2023 historic test year in this proceeding actually are from 2 winter heating seasons from January to March of 2023 and then November to December of 2023?
I'm sorry, could you repeat the question one more time?
Sure. Would you agree that the LNG costs included in the historic test year in this proceeding, the 2023 historic test year, that it includes heating costs from 2 separate heating seasons? So it would be November through December of 2023, and then January through March of 2023.
Yes, I'd say that's accurate because it does go between 2 calendar years for the heating season cycle.
Okay. Isn't it true that LNG is much more expensive than CNG to deploy?
On average, CNG could potentially be higher cost, yes.
No, my question was whether LNG was typically more costly.
Oh, I apologize. Yes, LNG is typically it could be more costly than CNG depending on how the usage is completed.
Going back to your rebuttal testimony, hearing exhibit 127 at 24 in the table we were just looking at. The costs in table LGR3 relating to LNG were only used for 1 location. Is that correct?
That is correct, yes.
Yet the costs for CNG in table LGR4 was for 8 different locations. Is that right?
No, not necessarily. Those are potential locations that can be used for CNG. I don't believe all 8 locations use CNG during this historical test year.
Can we pull up your, let's see, your direct testimony, hearing exhibit 104 at page 46? We'll go to footnote 26. Does it say there that 6 million of the total relates to the use of CNG at various facilities in Keystone, Aurora, Lyons, Meade, Longmont, Boulder, Grand Lake, and Pagosa Springs in the 2022-2023 and/or 2023-2024 heating seasons?
Yes, it says 600,000, not 6 million.
Well, 0.6 million is what I read.
Oh, I apologize. I thought you said 6 million.
Yeah. So, so the point is that we can go back to the last exhibit in the tables. It's hearing exhibit 127 at 24. Right. Thank you. You were quick on that. So the point is the $5 million for LNG was only used for one location, and the $357,000 was used for all the locations, for deployment at all the locations that we just listed in the footnote of your direct testimony. Is that right?
That's correct.
Referring to page 192 and 193 of hearing exhibit 500, can we go there? This is Corey Skluzak's answer testimony in this proceeding. $192. Oh, great. So at the bottom, Mr. Skluzak specifically talks about the commodity costs for LNG and that they're much higher than natural gas used by public service in its pipes. Is that right?
That's correct.
Do you disagree with the figures that he put in lines 22 of page 192 and then lines 1 through 5 of 193, where he says that commodity component of LNG for the 2023-2024 season was $21.29 per MMBTU, and PSCo's GCA cost for the fourth quarter of 2023 was $3.65 per decatherm or MMBTU for both commodity and upstream costs. Do you have any reason
to doubt his numbers? No.
Okay. So he concludes that just the LNG commodity cost is 583% larger than the all-in GCA costs for both commodity and upstream costs. Is that right?
That's what it states here, yes.
Are you aware of a decision earlier this year? You can pull this down, thank you. A decision earlier this year relating to public services GCA adjustment and the company's attempt to recover LNG procurement costs through the GCA?
I'm vaguely familiar with it, yes.
And do you recall Judge Farley's decision there that the upstream costs and total costs of LNG are substantially higher than the same cost for delivery of non-CNG LNG natural gas?
I would have to take your word for that. Again, on the GCA determination, I would recommend talking specifics with Mr. Pette.
Okay, well, we can pull up the exhibit if that would refresh your recollection. We can pull up the decision.
Okay, that's fine.
It's hearing exhibit CWS, or hearing exhibit 500, and it would be CWS 90. It's page or paragraph 38, which I think. There you go. Halfway through this paragraph, the Judge Farley states, this is an important question given the upstream costs and total costs of LNG are substantially higher than the same costs for the delivery of non-CNG LNG natural gas, and the Commission has emphasized the need to carefully consider the impact of its decisions on the affordability of utility service. Does that refresh your recollection?
It does, yes, I read that there, correct.
By the way, did Public Service request a CPCN to deploy LNG in Breckenridge?
I'm not sure.
Okay. And going back to hearing exhibit 127 at 24, thank you. The LNG commodity costs represent approximately 2.2% of the total LNG expenses in the 2023 calendar year. Is that right?
That seems accurate, yes.
And so the LNG third-party vendor costs, no, you know what? I wanted to refer to one of your discovery responses, because it looks like the third-party vendor support costs that are in this table are higher than what you stated in response to discovery. Is it true that over time you guys changed your third-party vendor support costs for LNG between your direct and rebuttal testimony?
Could you perhaps share the discovery response with the witness?
Sure.
Thank you.
It's here, out of UCA's box, it's hearing exhibit 516. Will you identify this for the record, Ms. Gilliland?
Yep, I see it's proceeding number 24AL-0049G, discovery request UCA 2710.
Okay. And it talks about this table that we were just referring to and the 119,138 for LNG and approximately 5.2 million for third-party vendor support costs. Do you see that?
I do, yes.
And subpart A asks how much the third-party vendor cost support changed from your direct case.
Yes, I see the 5.2. And then is that what you're referring to? I'm not sure what the specific.
Right. So that subpart A, your response, it looks like you reflect there that the difference between what you provided in your direct case and that what was provided in your rebuttal case is 574,000.
Right, it's showing the difference between the two amounts from October 22nd to September 23rd versus the 2023 actuals of the difference.
All right, and you're the one that sponsored the response to this request, is that right? We can scroll down to the bottom.
Yes.
Chair, I'd like to move for admission of hearing exhibit 516.
Any objections?
No objection.
So moved.
Thank you. You can take this down. So at pages 28, lines 9 through 11 of your testimony, you state that 2 acres are needed to deploy CNG versus what space is needed for LNG deployment. Is that right?
That's correct, yes.
And you use the space needs for CNG to support the company's decision to deploy the more expensive LNG to Breckenridge. Is that correct?
There's a specific need of why LNG is needed in Breckenridge versus CNG.
And part of what you state in your testimony is space constraints for CNG?
That is part of the reason why, yes.
Public Service did not even evaluate the availability for land for the deployment of CNG in Breckenridge. Is that right?
I would say there was very limited options available for the site access, where LNG was the sufficient decision of what we needed to deploy to meet capacity needs for Breckenridge.
Can we pull up from UCA's box hearing exhibit 520? Ms. Gilliland, can you identify this for the record, please?
Yes, UCA 2717.
Can we scroll down? Are you the sponsor of this discovery response?
Yes, I am.
Commissioner Blank, I move for the admission of hearing exhibit 520.
Any objections?
No objection.
So moved.
All right, so in this question, subpart C, UCA asked, did Piesco have 2 acres available in Breckenridge? And your response at the very end of the response here, it says, as LNG was the appropriate solution for the constraint at issue, Public Service did not evaluate the availability of land for CNG in Breckenridge and did not otherwise have it available for CNG deployment. Did I read that correctly?
Yes, you did.
So in other words, Public Service did not even evaluate the space needed for CNG in Breckenridge.
As I mentioned, there was very limited availability for various acres of land, and LNG was the option that we chose to move forward with.
For the past couple of winter seasons, Public Service only injected LNG gas into its gas system in Breckenridge once. Is that right?
That is correct.
This was a little confusing because in response to a discovery request, it's hearing exhibit 514, UCA 27-6B. Can we scroll down? Ms. Gilliland, I think you're the sponsor of this response.
I believe so, yes.
Correct. Okay, thank you. Commissioner Blake, I'd like to move for admission of hearing exhibit 514.
Any objections?
No objection.
So moved.
Thank you. Can we move to subpart B real quickly? It says the purpose of, oops.
Sorry, do you want the question B or the answer B?
I guess we can go to the question first. So the question asks that Piesco to admit that it has not used LNG in Breckenridge for the prior 2 winter heating seasons, specifically for peak shaving solutions during periods of high peak hour gas demand. And so let's go to your first response. I think you have a supplemental response. We'll go first. So it says, let's move down a little further. It looks like you didn't respond in the supplemental. So you say in subpart B, your initial response in August was the purpose of a need for LNG is discussed in your testimony. While it's correct that system pressures were maintained without the need to actually inject LNG, LNG was still required to be available to ensure reliable service. Did I read that correctly?
You did, yes.
So at that time in August, you state that LNG was not injected into the system. But then just last night, UCA received responses to additional discovery. And I think we've got a hearing exhibit 534 in our box. And it would be UCA 30. Oh,
sorry. Doesn't look like there's a 534. I've got up to 531. I can double check the web version to make sure that it's not a syncing issue, but I don't see a 534.
Okay, it was just added this morning, so
give me a second, I'll check the web too, but
well, and maybe we can do it this way. Ms. Gilliland, did Public Service later amend its representation that it never injected LNG into the Breckenridge gas system in its most recent responses to discovery and say that in fact it did inject LNG once in the gas system in Breckenridge?
I would object on the grounds that this is a vague question, and if there's a discovery response, which it looks like it's on the screen, I would ask that the witness be allowed to refer to that.
The objection's overruled, but Ms. Gilliland, you're welcome to look at the discovery response before answering.
Okay, thank you.
Can you please identify the document on the screen?
Yes, discovery request UCA 33-9.
And were you the sponsor of this response?
Yes, I believe so.
Okay, let's look at D. So of course, public service has objections to responses, but yesterday we got the response that said, let's see. Halfway through the response, it says, with that clarification, it is correct that the LNG commodity, while not required to be injected to support system pressures, was injected at the end of the winter heating system into the company's system and used by customers. Is that accurate?
That is accurate, yes.
Was it only used once?
Yes.
Thank you. What did public service use, if anything, to meet system constraints in Breckenridge for heating periods prior to 22-23 when you first injected LNG?
Prior to having our LNG system installed, we had determined that there were potential capacity constraints on the system. And so we actually chose to install the LNG as a non-pipeline alternative. The other alternative would have to be an evaluation of actually building a larger pipeline up in that area for larger capacity needs. So that is when we actually took a change of route of looking at an MPA, which is the LNG option, to ensure that we have capacity to be able to support our customers in the Breckenridge area for those cold winter days.
But you didn't use LNG prior to that time period, correct?
That is correct.
And to date, public service has only deployed LNG in Breckenridge, correct?
As of right now, yes, that is correct.
Does public service plan to continue to deploy Breckenridge or LNG to Breckenridge?
Yes, we are continuing to look at Breckenridge and deploying LNG in that area. Yes.
And at page 25, lines 11 through 17 of your rebuttal testimony, excuse me, I'm having a hard time this afternoon. My mouth is dry or something. Blah. So you testify that the company is going to present an expansion of LNG in a larger NPA portfolio. Is that right?
That is correct, yes.
In what towns or locations will LNG likely be needed in upcoming winter seasons?
Like I've mentioned in my testimony, Witness Marks is actually working with his team on the long-term planning of where the appropriate LNG will need to be deployed across our footprint.
And does public service intend to file a CPCN with the commission regarding that deployment?
I would say that would be handled under Mr. Marks's team to be able to look at that evaluation and the needs to file that CPCN.
So you don't know at this point?
I do not know.
Is future LNG deployment planned to address an existing capacity constraint in the Eastern Mountain System?
I would say we are evaluating all systems. And again, Mr. Marks's team is doing that evaluation for further NPAs across our system for capacity constraints.
Okay, just out of curiosity, what towns are in the Eastern Mountain System?
In our Eastern Mountain System, it would be anything east of our specific, I don't know the specific cities off the top of my head, honestly, right now.
Okay, that's fine. All right. So it looks like the company has also gone ahead, in addition to the third-party vendor costs, and we can take down that exhibit that's up right now. Thank you. For the third-party vendor costs that are part of this case, the company has gone ahead and purchased its own LNG equipment. Is that right?
That is correct, this year in 2024.
Can we pull up hearing exhibit 519 from UCA's box? It's another response to discovery. Will you please identify this for the record?
Yes, discovery request UCA 2721.
21.
Yes,
And are you the sponsor of the response?
I am, yes.
Mr. Chair, I'd like to move for admission of hearing exhibit 519.
Any objections?
No objection.
So moved.
So this question goes to public services purchases of modular LNG equipment that you described in your rebuttal testimony. Can we scroll down? Past the objection. All right, here we are. So in response to our request for how much money was spent on that, it looks like the company spent $3.6 million for its own LNG equipment. Is that right?
That is correct.
And then you also state the company will have expenditures to, among other things, operationalize the equipment on the system, correct?
That is correct.
And does the company intend to seek reimbursement of these costs in a rate base or base rate case, a rate case proceeding beyond today's rate case proceeding?
That is correct, as these are purchases made in 2024 and we're on the 2023 historical test year. So yes, it'd be future.
This LNG acquisition plan and purchase was not included in the GIP proceeding, was it?
I don't believe so, but I'm not 100% sure.
Can we pull up hearing? I guess it's on the same discovery response. Looking at subpart C, do you see acquisition of the modular LNG equipment was not planned at the time the GIP was filed in 2023?
Correct, yep.
So it wasn't
No.
filed in that proceeding. And is it true that this equipment will be deployed in Breckenridge?
That is correct.
The same place where public service is requesting reimbursement in this proceeding for $5.2 million in LNG costs?
Yes, the same system.
Will the company-owned LNG equipment well, I guess my next question was really relating to the fact that the company is requesting reimbursement for the third-party costs for the same location where it's now spent money to deploy its own equipment there. Is that right?
That's correct. It was third-party rental. We purchased our own in 24. That will be our own equipment.
Okay, we can take this down and I'll move on to my next topic. Mr. Chair, I only have a couple more topics.
Okay.
Let's talk about use of LNG on a design day versus the use of LNG as a peaker plant. In your rebuttal testimony at page 30, lines 7 through 9, you mentioned that the company deployed LNG to provide service and ensure that outages would be experienced, that outages would not be experienced during design day conditions. Is that right?
That is correct.
And a design day, by definition, is based on the probability of a 1 in 30-year design day occurrence, correct?
That is correct.
And a 1 in 30 design day is a temperature that's expected to be colder than every other day except 1 in 30 years, correct?
That is correct.
In your rebuttal testimony, you also mentioned that the use of LNG in Breckenridge can be done as a peak shaving facility. Is that right?
Yes, that was in my, yes.
Will you explain how a facility shaves peak demand?
Within my testimony, I think it was more of a reference to indicate that it would be similar in comparison to a peak shaving plant of using it on such days as capacity is needed on those cold weather temperature days.
Isn't it true that the sole reason that the company decided to first deploy LNG was to meet a 1 in 30-year low temperature design day?
The design day is the absolute coldest day to be able to deploy that. When we look at deploying the LNG facility in the Breckenridge area, it can start as starting to look at -17, which is not the design day to be able to make sure that the equipment is ready for capacity needs if it does get to a colder temperature.
Can we pull up hearing exhibit 500, attachment CWS 89? And can we go to page 9?
89 only has 2 pages.
Oh, okay, that's where I was going to ask that we pull up the box copy of this document. Mr. Chairman, I referenced this the other day. We realized when we were preparing for the hearing that Exhibit 89 to Mr. Skluzak's testimony inadvertently only included 2 pages, but the exhibit was supposed to include the entire piece of Mr. Trowbridge's testimony. And so I circulated that yesterday to all the parties and asked whether anybody would object to us actually replacing the hearing exhibit CWS 89 with the full copy of the testimony. And I didn't hear anything this morning as to whether anybody would object to that. So we put it in our box, and there it is actually referred to as CWS 89 revised 1.
Do you have any objections to Ms. Singer-Nelson using this to cross-examine Ms. Gilliland, Ms. Simard-Pacheco?
That's a broader question. I don't have an objection to this document coming in, given the uploading issues, as it was an attachment to Mr. Skluzak's testimony. However, I do have an issue with using this document, which is from a different company witness and formerly in the regulatory group, to cross-examine Ms. Gilliland to the extent it's going to be used for impeachment or anything else. It's not her testimony. And she's provided very robust testimony in this case on LNG and the needs for LNG, not only in the coverage area, but that would be my response.
Well, I guess, Ms. Singer-Nelson, you have a clean right to get this into evidence, but, and we'll take it there and we'll take it from there. So, how would you like to proceed?
The only reason I was going to walk through this, and by the way, this is Public Services Company representative's testimony in a proceeding where it attempted to recover these same LNG costs from the GCA. So it is something that I think is permissible to use in the questioning.
Before we get there, just let's move it into evidence.
Okay.
So I'll say it's admitted in the evidence. And is it your intent to use this to cross-examine this witness?
Yes, just briefly.
I guess I'm struggling to see the concern that you have, given it that it's a former given that it's a company witness in a different case. It's I think this seems legitimate to me. I'm not sure I understand the objection.
Well, perhaps we can, let Ms. Singer Nelson ask her questions. I don't know to what extent Ms. Gilliland is familiar with this testimony. She didn't testify in that case. She was not a witness in that case. She's an operations witness in this case testifying on LNG. So what a regulatory witness said in a prior case may not be appropriate. So we can proceed with the questions, Chair. And if I have objections, I'll lodge them at that time.
Please go ahead, Ms. Singer Nelson.
Thank you, Mr. Chairman. And Ms. Gilliland, this is really to address your testimony that talks about using now LNG as like a peaking plant versus the use of LNG to address design date conditions. Can we go to page 9 at lines 18 through 22? And by the way, this is the testimony of Mr. Trowbridge. Do you see the question? Let's see, 18 through 22. What is a design day condition? And he responds, consistent with what you just said, that a design day refers to a 1 in 30-year low temperature for a given weather zone. And then at a little above there, from line 6 through 17, he asks himself, how does the company determine the need for LNG or CNG? And he responds, on an annual basis, beginning after the conclusion of the heating season, the company's hydraulic models are calibrated with system operating data from the past heating season to confirm whether the gas system is continuing to meet our system-specific design day conditions. So there it appears that Mr. Trowbridge was explaining that LNG and CNG were specifically used to satisfy design day conditions. Is that right?
That's what I'm reading here, yes.
He doesn't talk about peak shaving there, does he?
He does not, no.
And then going to page 12, lines 4 through 7. Are LNG and CNG seasonal deployments only? And he responds, yes, they're seasonal deployments that are used only during the heating season when the company faces the risk of not meeting design day requirements. Again, he doesn't talk about peak shaving there either.
That's correct. I don't see that on here.
Circling back to rebuttal testimony, we can take this down. Thank you. You liken the LNG deployment in Breckenridge as not dissimilar to a peaking power plant that operates when called upon to do so. Does that sound correct?
Yes.
Can we pull up hearing exhibit 515? Will you identify this document for the
Yes, discovery request
record, please?
27-7.
And are you the sponsor of this response?
I am, yes.
Mr. Chairman, I'd like to move for admission of hearing exhibit 515.
Any objection?
Would you mind scrolling to the bottom just so I can confirm the sponsor? Thank you. No objection, Chair.
So moved.
Okay, and I'd like specifically to go to the question for 27-7A and then the response. So the question is Ms. Gilliland referencing a peaking power plant just for an electric utility? If so, please explain a peaking power plant for a gas utility. And the response? Is yes. You're generally referencing a peaking power plant for an electric utility, and you're not referring to public services electric utility. And it's clear from rebuttal testimony that that it's only being used as an analogy. Is that right?
Yes.
Peaking power plant for an electric utility is available to provide electricity when there's high demand, correct?
That is correct.
For example, on a 100-degree day, public service may employ a peaking power plant to meet its air conditioning demand.
I would say that's accurate, yes.
Wouldn't it be more cost effective for public service to use traditional natural gas and non-pipeline alternatives, even CNG for peak shaving, than to deploy extremely expensive LNG to shave the peak?
When you look at the difference between LNG and CNG, if you're needing it to actually provide capacity at peak demand on a cold day, even to the extremes of design day, you would need to be able to deploy LNG due to actually needing that higher volume of supply, being able to provide the demand load to the customers, so they do not have interruption of service.
So you're saying at times the company believes LNG is more cost effective than CNG?
I would say LNG is the appropriate use of commodity to be able to supply our customers on demand days to ensure that they do not have interruption of service.
But at a higher cost.
It potentially could be at a higher cost, yes.
Now, my last topic relates to safety issues. And I'll just briefly address your response to UCA's testimony on the need to provide information to the Commission on the safety of LNG in every case where cost recovery for LNG is sought. At page 31, lines 18 through 22 of your rebuttal testimony, you state that the company provided information regarding its planned use of LNG in a proceeding number 23A-0325G. And that happens to be the same proceeding that Mr. Trowbridge's testimony was filed in that we just referenced. And you state at the very bottom that the company provided testimony on the characteristics, value, costs, and planned use of CNG and LNG in proceeding 23AL-0325G when requesting recovery for the cost of third-party CNG and LNG services through the GCA. This testimony was filed over a year ago in a case that UCA was party to. Now, isn't that the proceeding where Judge Farley denied LNG procurement cost recovery and found that public service failed to address the relative safety of LNG and CNG versus the conventional method of alleviating pipeline constraints and delivering natural gas to customers?
I object to the form of the question and that it's characterizing the decision by Judge Farley, but if you could put the language from the decision in front of her, she may be better able to answer.
Okay. Can we pull up hearing exhibit 500? I'm sorry, it would be the attachment 90. Looking at page 16. Yeah, and it would be paragraph 39. So, Ms. Gilliland, can you see Judge Farley's statements?
Yes, sorry, I was just reading them.
Okay, good. Yeah. So starting in line, it really starts at line 2, where he says, while public service often repeats in its testimony and SOP that it must provide safe and reliable service to its ratepayers, it never addresses the relative safety of storing and using CNG or LNG to address pipeline constraints versus the conventional method of alleviating pipeline constraints and delivering natural gas to ratepayers. This deficiency in the record is notable given that the Commission specifically requested such evidence in decision number C23-0059. So there in the, Judge Farley noted that it's important to the commission and Judge Farley that the company always provides sufficient information in the record so the commission can evaluate the deployment of LNG, correct?
I would say that looks accurate based off of this statement, yes.
And also to evaluate the prudency of the costs of LNG. Correct?
I would say yes. Sorry, I was just rereading that one more time.
Sure. Thank you, Mr. Chairman. I have no further questions. Thank you, Ms. Gilliland.
Thank you.
Thank you, Ms. Singer Nelson. 50 minutes exactly. So nicely done. Commissioner Plant, questions for Ms. Gilliland? For the record, that's a no. Commissioner Plant is having trouble unmuting and shaking his head now. Commissioner Gilman.
Hi, good afternoon, Ms. Gilliland.
Good afternoon.
A few questions for you. First, regarding the quality service plan or QSP. So if I'm getting it right, it sounds like the current plan is for no changes to the QSP now as proposed by the company, but potentially some stakeholder process to look at that QSP prior to 2026 filing. Is that accurate?
Yes, except we are proposing that decreased number in the grade 2 leaks, but the other ones would stay the same for the 2026.
Okay, so sorry, decreased timeline for grade 2?
Yes.
Okay. So I'm just curious, kind of given the scope of the QSP and changing policy considerations within the state, do you see other areas as being important to explore as you move forward with those stakeholder discussions for possible inclusion in the QSP moving forward?
Yeah, I would definitely say the grade 2 leak QSP will be one to reevaluate, look at, especially now that we'll be moving into the advanced leak detection technology and how we'll be quantifying looking at our leaks overall in that period of time. It is going to change the methodology as we move forward, why we are proposing that number and not anything less at this time. So I think when we look at with the new advanced leak detection, it definitely will be something to evaluate further once we get that further more defined as we move into those new types of processes here.
Okay. Has the company already purchased advanced leak detection equipment, or that's something planned?
No, it's something planned. We have not purchased it yet.
Okay. Outside of just revisions to kind of perhaps some leak detection and timelines, do you foresee any other areas of performance or policy that you could envision being included within the QSP?
Not at this time. I feel like those 3 metrics are very sufficient metrics for us as we look from a gas operations standpoint of making sure that we're committing to our safety needs, looking at our gas emergency response, looking at the damage ratios across the board, and then also to the leakage ratio, I think will be the biggest factor as we move forward. But at this time, we haven't considered anything further than those 3.
Okay. Another company proposes, as I said, keeping the QSP, certainly the dollar levels the same. And I was just curious, given the significant inflation over the past few years, with this being, I believe, a 2022 vintage document and moving it all the way forward to 2026 without any adjustments, wouldn't that result in significantly lower real dollars that are essentially a part of the penalty structure as we move forward in the years?
I would say yes. I mean, if we keep the same dollar amount as we've had today, it would stay flat compared to any additional increases in penalties based off of the current metrics.
Okay. Okay, so you discussed the characteristics of CNG and LNG in your testimony. Heard a lot about it already. I'm curious for the Summit County application, you've discussed, and just to be clear, not like a piece of paper application, but the use, I guess, is how I'm using it. You've talked about the purchase of the equipment. So for the prior 2 winter seasons, this has been a contract, right? 22, 23, and 23, 24. What will be the structure in this upcoming winter season? We are just now about to start the 24, 25. Will that be a contract, or will you be using the purchased equipment?
No, for the 24-25 heating season, we'll be using the purchased equipment. So that's what we've been moving towards, is getting away from the third party type of vendor usage that we've had over the past 2 heating seasons, and why we purchased the new equipment that we can actually maintain and have that in place for a long period of time.
Okay, and when do you actually expect delivery of that?
I believe, actually, I don't know off the top of my head of when that's going to be delivered.
Okay. Do you have any obligation to continue, or any kind of sunk costs associated with the contract when you stop contracting for the service?
No, we definitely took that into our planning phases of evaluating that third party cost, and planned within Mr. Martz's group of looking at that, when would we purchase that equipment and actually have that deployed. So we definitely took that into consideration of when we would be canceling our third party contract to when we would actually be purchasing the equipment and using our internal workforce for that asset.
Okay. And with regard to siting of that equipment, is it, I guess, currently with the contract situation, is it currently on a public service owned or controlled site?
No, I believe it was rented for the last 2 heating seasons, and we're currently acquiring the final land for moving forward for this winter season moving forward.
So it's the same site, you're just trying to own the site instead of rent the site?
No, it will be a different site. It's not the same site as it's been for the past 2 years.
Okay, so public service is looking at acquiring land to site the equipment you have bought to provide this?
Yes,
service.
correct.
Are there additional kind of interconnection costs? I don't know if that's the right word, but to be able to now inject in a different location than you had been injecting in the past?
There'll always be additional costs for the interconnection of that, but depending, you still have to have certain asset locations and being close to certain regulation points within the system to be able to meet that demand potential need on the system. So it wouldn't really have additional cost impacts due to the site location moving very minimally on the system.
Okay. And were there costs for the integration? I suppose there are, since you said there are always interconnection costs for the interconnection that is being abandoned, essentially?
I would say minimal. I don't have the specific amount of what that dollar amount would be from the decommissioning standpoint of the current site to moving it to the new site, but there would be decommissioning costs associated with decommissioning the current location, which was decommissioned at the end of the heating season prior. We always decommission at the end of the heating season. So that's already been taken care of, and now we'd be standing up the new commissioning of our new site as well.
But you're going to use the contract site again this winter, so it's not been decommissioned yet, right?
No, the current site of where we had been using land prior is not going to be used this winter season. There will be a new site location that will be utilized for this winter season with the purchased equipment.
Sorry. Okay. You're not using the purchased equipment this coming winter, right?
No, we are. The purchased equipment will be used this winter season. The
Okay.
rent equipment was for the 23-24 heating season. We'll be using the purchased equipment for the 24-25 heating season.
Okay, perhaps I misunderstood you before. I thought we had one more winter of contract.
No more winter of contract.
Okay, So you're on a new site, have already just decommissioned the old site, and you do not yet own the new site. Is that all accurate?
The land, yes, correct.
The land, yes. Okay. Okay. And just to be clear, you're looking at purchasing that land rather than renting or leasing that land.
From my understanding, we're exploring all options. We don't have a final confirmation of what the land will be purchased or rented on yet.
Okay. Thank you. Sorry, I got confused. So you referred earlier in your testimony to the term NPA or non-pipeline alternative when referring to the LNG project. And I just want to be clear, this is not an NPA that has actually been through a GIP or been presented in a GIP to the commission. Is that correct?
That's correct. It's more of looking at that non-pipeline alternative instead of actually building a new pipeline, or if you're looking at the capacity needs for the system, there's really those are your two options of being able to have LNG to be able to supply that on the design and the demand date, or looking at building that larger capacity pipeline. So we of course chose the option of looking at another alternative of the LNG to help with supply on the capacity.
Okay. You know, in your testimony that a separate filing will be presented to the commission in 2024 regarding a larger NPA portfolio and overall proposal. When is that expected to be filed?
I don't have that exact date, so that will be witness Mr. Martz. His team is actually working on that full NPA portfolio and that filing requirement as well.
Do you know if and for how long LNG is projected to be part of what the company will put forth as a larger NPA portfolio for the area?
I do not have the specifics, but I know LNG is definitely a part of the NPA portfolio for other locations as we move forward as part of that.
Okay. So I did have a question about how frequently and to what extent the LNG sited in Breckenridge had been used, but you did cover that somewhat with Ms. Singer-Nelson. So I'm a little lost on it though, because I understood the purpose of the siting to be to handle design day situation, where pressure on the system might reduce because of too much use, not enough availability. But it sounds like that's not the circumstance for which it was used the one time it was used. So can you help me understand what it was used for?
Sure. So on the time that it was used, when we have LNG in the tanks and ready to be injected into the system for supply, when we do the decommissioning, we have to empty those tanks to be able to transport them and move them off site. And so we injected the LNG for commodity use into the system at that time.
Understood. And that's just one second. So you stopped using the contract equipment. You're going to use your own equipment now, or was there some transfer that I'm missing that wasn't one of those two things?
Yeah, so this for the 23-24 heating season, when you decommission those tanks to be able to move them off site, we have to inject the remaining LNG within those tankers to be able to move them in a safe condition off site of that location. So that was taken care of, and the LNG was injected into the system at that time, when that's separate of this heating season coming up with the purchased equipment.
Okay. So essentially between 22-23 and 23-24, whatever wasn't used was able to remain in there basically. But then because you ceased using the contractor, they had to get their equipment away. And in order to move their equipment away, it had to essentially be purged, and it was purged into the system.
Correct. But both heating seasons, we decommission the units and remove them from the sites both times. So they did not stay up there for the full year. We actually recommission and decommission as those tankers have to be moved off during the heating season.
Okay, so what about when it's your equipment? Are you going to have to decommission it, or maybe not have to? Are you going to decommission it every spring?
At this time, I do not know the specific answer on the current equipment we'll be purchasing and how that will be used for the decommissioning or keeping that on site intact during the season. So I unfortunately I do not have a specific answer for you at this time.
Okay. Does the company have data on the measured shortfall as they see kind of system as is conditions from SCADA data and whatnot from the prior heating season to understand if the shortfall in that area is growing or shrinking?
Yes, so our ISP organization, which falls under Mr. Martz and others, is able to do predictive modeling of the forecasting of our design days and what that capacity needs or need to be met. So that can definitely be modeled to see where those capacity constraints are on the system.
Is that being done? Does the company understand if the shortfall in the area of concern is growing or shrinking?
Yes, so I would say those capacity checks are being evaluated to ensure that we are still in need of additional capacity support the design day as well as load on the system for our customers.
Do you know if the shortfall is growing or shrinking?
I do not know.
Let's see. So this was just identified prior to the 22-23 winter season, right?
Correct.
And what's projected right now is essentially the same need for CNG in the same quantity as was identified several years ago when it was first identified.
I would say yes, the LNG need is still there from a capacity need, but witness Mr. Martz would be able to provide more specifics on exactly the modeling and behaviors of capacity constraints we've seen over time.
Okay. Public Service Company of Colorado had for at least 2 winters that I'm aware of run a gas demand response pilot program in Summit County, which Summit County is the location of Breckenridge, if you're not familiar. To your knowledge, has that pilot been used at all to try to minimize the shortfalls in this area of concern?
I am not sure on that.
Are you aware of any results, reports, or other information that the company has or has made available regarding the company's gas demand response pilot in this area?
Again, I'm not as familiar with that. I would think another witness would be able to support the current needs on that.
Okay. Let's see. So you note in your rebuttal testimony that the decision essentially to go with LNG in this area was made with cost consciousness at its core. I'm just curious, what was the company's rough estimate of the infrastructure costs associated with increasing the capacity in the area instead through traditional infrastructure means?
As far as the cost of LNG versus the traditional of installing a pipeline?
That's correct.
Okay, so if we were actually going to be installing a pipeline in this area, it would have cost upwards of 100 million plus to be able to do that, if not more. And so we chose the option of LNG to support those capacity needs instead.
Are you aware over how many years of growth or what growth assumptions were made with regard to the sizing of that replacement of traditional infrastructure?
I am not.
Okay. I did some quick research only to find out that Breckenridge is apparently at 93% of its residential build out. So apparently, in what I'm seeing, not a lot of room left for additional residential development. Don't expect that you have looked that up, but just perhaps to interject on future growth potential for the area. Has the company begun either when the need was identified or in any time in the interim, has the company begun any specific efforts to slow or reverse capacity growth rates in the particular area of concern?
Not to my knowledge, not at this time, no.
How large are you able to kind of describe geographically where all the area of concern is in terms of use that leads to the capacity shortfall?
I can't give specifics, unfortunately. That would fall under our integrated system planning group that provides the long-term capacity and the evaluation of capacity constraints for various needs on the system.
Has the company pursued or proposed a moratorium in the area to slow or stop growth to address the shortfall?
Not to my knowledge, no.
Is that something the company's done in the past in other areas where they've run into capacity issues?
I think it's been a point of discussion. I'm not aware of any specific mandates that we've done in the past.
Those are my only questions. Thank you.
Thank you.
Thank you, Commissioner Gilman. Just a couple quick follow-ups. It sounds like the company purchased some LNG equipment in 2024. If you had this equipment last heating system, do you have a rough sense of how much the total LNG spending would have been reduced?
I do not have those figures off the top of my head, Chair Blank. That would again be something for Mr. Martz to have provided with the evaluation of that purchase.
But the rough idea is once you have the pressurizing and deep pressurizing commitment, it's just sort of normal commodity gas. That's the commodity input. Is that sort of like the rough intuition?
Yes, I would say that's correct.
All right. And just from your answer to Commissioner Gilman, it sounds like the LNG equipment stays in Summit County all winter. Is that right? It's not like if you have a crisis somewhere else, you can move it within a couple days somewhere else. It's not like whack-a-mole. Once it's in Summit County, it's there for the entire winter. Is that the right intuition?
Yes, that's my understanding, is that it cannot be moved to various sites to support other needs.
Okay. Just a couple questions on cost allocation. Right or wrong, I picture sort of large multi-million-dollar second homes going up in Summit County are leading to this gas system capacity shortfall. Yet at the same time, as I understand it, we're being asked to socialize this $5 million, maybe not a year cost, or maybe the $100 million capital cost of the long-term solution across all customers, including IQ customers. To the best of your knowledge, has the company conducted any analysis to see if the revenues from the added gas sales in Summit County offset these costs?
I am not aware of any of those at this time, no.
Given that none of these costs are on the new customers and they're socialized across everyone, from a customer perspective, is it fair to say that there is less incentive for these customers to go all electric or engage in demand response?
I would say that this is providing the customer choice of still wanting to stay on the gas system, and that we're needing to make sure that we can provide them an additional capacity and supply on the system while we're still here to serve them, and making sure that they do not have interruption of service at this time.
Yeah, but for those customers, those new customers that say it is $100 million to serve those new customers, I mean, it's great that they want natural gas, but they're not paying the full cost that they're imposing on the system. Is that fair?
That's fair.
All right. And if the commission in this case wanted to, with whatever we do with these expenses, if we wanted to issue an order, requiring you to, look at the revenues versus the cost as part of any future process, and look at creative ways of, more fairly internalizing those costs in the future. So the incentives for demand response, all electric, are based on the true underlying economics. Any concerns, advice, or guidance you might give us if we choose to do that?
I would say we definitely could look at the additional portfolio that we plan to file at a later time of the NPAs and what that analysis could look at as we move forward into the future for the system.
All right. That's all I had. Any redirect?
Yes, Chair Blank. Give me just one moment. Ms. Gilliland, I'd like to start with QSP. do you recall the questions, just kind of going back to the beginning, it's been a little while now, but do you recall the questions that were asked of you by staff about the company's gas QSP?
Yes, I do.
And currently, Ms. Gilliland, are all of the company's gas QSP metrics safety focused?
Yes, they are.
Staff asked some questions regarding the grade 2 leak repair metric. Do you recall those questions?
Yes, I do.
Why did the company propose a reduction of this metric from 52 days to 40 days instead of the 28 days recommended by staff?
Yep, so we took the 3-year average of looking at the overall reduction. And as I had mentioned previously, we're really looking at where we're going and heading with the advanced leak detection technology and what that's actually going to do for the ratio and bringing down leakage overall on our system.
Thank you. Ms. Gilliland, you were not involved at all with the electric QSP, is that right?
That is correct.
And is it fair to say that you're not at all familiar with its metrics?
No, I am not.
Is the company nevertheless supportive of working with stakeholders to discuss future changes to the gas QSP?
Yes, we are.
Is there another company witness who's more familiar with the regulatory process and how that would be accomplished?
Mr. Pette would be able, witness Pette would be able to provide more clarity on that.
Thank you. I'd like to switch to another topic. I would like to talk about LNG and CNG briefly. Can you please elaborate on why the availability of both LNG and CNG as supplemental supply going forward is so important to the company?
Sure. I'll start with LNG. As I've mentioned previously, when we're looking at capacity constraints across the system and depending on the supply needs on those cold temperature days, LNG is more of the appropriate need depending on the full capacity of the customers that we have to provide that demand and supply to. CNG as well is another great supplemental supply alternative to be able to serve and deliver to our customers on cold days, as well as for other times where we potentially might need CNG, where we have to take, instead of having a customer be out on an outage, we're able to deploy CNG to keep them online without any type of interruption of service.
Now, thank you for that. You were asked a series of questions by counsel for UCA regarding the various commodity costs. Do you recall that?
I do.
If we could please pull up Hearing Exhibit 127, Rev 2. And if we could go to page 24. I just want to clarify, looking at tables LGR3 and LGR4, particularly the commodity costs. Do you see those lines?
I do, yes.
And I believe you testified earlier that those commodity costs have been removed from the cost of service in this rate case. Did I call that correctly?
Correct.
And you, I believe, were also asked if those commodity costs are being recovered through the gas cost adjustment. Do you recall that question?
Yes.
Is that a question better directed to another company witness?
Again, I would reference witness Pette to be able to provide more clarity on those details.
Okay, we can pull that down. Actually, keep it handy if you don't mind. Do you recall counsel for UCA referring you to Mr. Skluzak's answer testimony where he discusses the cost of LNG as compared to gas commodity in the gas cost adjustment?
Yes, I do.
And I believe you agreed that LNG was more expensive.
Yes.
And you also had a conversation with Commissioner Gilman about the cost of the traditional gas infrastructure. Do you recall that?
Yes, I do.
Did those cost comparisons contribute significantly to the company's decision to use LNG as supplemental support instead of the gas infrastructure?
That is correct.
And is LNG also being used for other purposes in the interim?
LNG is not, no, not the specific site up in Breckenridge is currently being used for LNG.
But the company is also making a mountain system filing this year. I believe you referenced that in your testimony, and Commissioner Gilman asked you several questions about that, correct?
Yes, that is correct.
Is the use of supplemental LNG given the company additional time to implement non-pipeline alternatives? Should those be approved by the commission in a future filing?
Yes, that is correct.
I would like to turn to hearing exhibit 519, which I believe is the company's response to discovery request UCA 27-21. And if we could move to the question for subpart D. That question reads, will the costs associated with this modular LNG equipment replace the costs that PSCO has paid to third-party vendors, or will it be in addition to those costs? Do you see that question?
I do.
Could we please go down to the response? Would you mind reading that response into the record, Ms. Gilliland?
Sure. The LNG O&M cost reference in Mrs. Gilliland's rebuttal testimony that the company has paid to third-party vendors was incurred during the 2023 test year, whereas the LNG purchased equipment is occurring in the 2024 and therefore will not replace previously incurred costs. Please also see Ms. Gilliland's rebuttal testimony at 30:14-20.
Thank you. We can take that down. Counsel for UCA also, in discussing the cost for LNG, at least the way I heard it, seemed to infer that that alternative was cheaper than CNG or compressed natural gas. Do you recall that conversation?
I do, yes.
If the company had chosen, which it did not for the reasons stated in your testimony, to deploy CNG instead of LNG, would that cost have been higher or lower than the cost of LNG?
It would have been higher, and also too, other variables were taken into consideration and outside of cost as well, but it would have been higher.
Give me 1 second, Chair Blank, to check my notes. No further questions for this witness. Thank you, Ms. Gilliland.
Thank you, Ms. Gilliland, and you're excused.
Thank you.
Appreciate it. I have the next company witness as Doyle. Is that correct?
That's correct, and we're going to be switching counsel for that. Before we do, however, Chair Blank, I would like to say at the end of the day today, we'd like to circle back around with you and the commissioners regarding your request related to witness Matley's hearing exhibit, which is the 15-year rate model, just to kind of have a plan before we recess for the weekend.
I had that high on my agenda, so we'll stop at 3:20 or 3:25 and make sure we have that conversation. Ms. Doyle, can you raise your right hand?
And Chairman, before we go on the record, before we get going with Ms. Doyle, I wanted to indicate that UCA will waive its cross of Ms. Doyle.
Oh. Ms. Doyle is smiling. Thank you, Ms. Crampton. Ms. Doyle, can you raise your right hand? Do you swear to tell the truth, the whole truth, and nothing but the truth?
I do.
You can put your hand down if it's anybody with you in the room or communicating with you in any way.
Nope.
And if that changes, you'll let us know.
Yep, will do.
And let me talk to my colleagues and see if you could be excused because I don't have any questions for you. Commissioner Plant, do you have any questions for Ms. Doyle?
I do not.
Commissioner Gilman, do you have any questions? I think Ms. Doyle, great job.
That was short, right?
Yeah.
All right.
Thank you. Thank you, Ms. Doyle. All right, I have as the next witness, Mr. Amen or Amen.
That's correct, Chair Blank. We'll see if he's on and available. I know Ms. Doyle went faster than we expected.
Fair enough.
We take a quick break so we can check in on him. He's actually in another location.
Yeah, so why don't we take a 5-minute break till 2, and then if he's not available, let's get going with Mr. Paquette or Mr. Freitas. Okay,
Okay, thank you.
thanks.
Mr. Amen, are you on and available?
Yes, I'm on. Can you
Okay.
hear me?
Yes, I can hear you.
Okay.
We're going to get started with you in about 2 minutes.
Mr. Amen, Amen, Amen,
Amen.
Amen. Mr. Amen, can you hold up your right hand and turn on your camera if you can?
Yeah, I'm not sure why the camera's not on.
Right. Do you swear to tell the truth, the whole truth, and nothing but the truth?
Yes, I do.
Is anybody in the room with you or communicating with you in any way?
No.
If that changes, you'll let us know.
Yes.
There you are.
Here I am.
Welcome.
Okay.
Ms. Herring.
Good afternoon, Mr. Amen. Can you please state and spell your name for the record, please?
My name is Ronald Amen, RONALD AMEN.
And by whom are you employed and in what position?
I'm one of two managing partners of Atrium Economics, Inc.
And did you prepare direct testimony and attachments in this proceeding that's been marked as hearing exhibit 115?
Yes, I did.
And you previously provided corrections to that direct testimony, is that correct?
Yes.
And do you have any additional corrections to your direct testimony?
No.
Are you sure?
Um,
If we can pull up hearing exhibit 115 Rev 2. This might
I
refresh
guess
your
the
recollection.
answer is yes, because I thought they were all in, if you will.
Yeah. They're not these, there's two additional corrections that I think we need to
Yeah, okay.
go through. And if we can turn to page 9. I think it's a little bit. Yep. And is this one of the corrections to your direct testimony?
Yes, this corrects a bad reference to a decision.
And if we can turn to page 15, please. And is this an additional correction you had to your direct testimony here on lines 5 through 7?
Actually, I thought that was an earlier one, but yes, this is a correction.
And then turning to page 16 at line 13.
Right, this corrects a number.
With that, the company moves for admission of hearing exhibit 115, Rev 2.
Any objections? Hearing none, so moved.
Did you also prepare rebuttal testimony that's been marked as hearing exhibit 134?
Yes.
Any corrections to your rebuttal testimony?
No.
The witness is available for cross-examination.
Thank you. I have 45 minutes for UCA. Mr. Bunker.
Yes, thank you, Mr. Chairman. Good afternoon, Mr. Amen.
Good afternoon, Mr. Bunker.
My name, as you just mentioned, is Greg Bunker, and I am an attorney for the UCA in this proceeding. Nice to meet you.
Nice to meet you.
If we could start with your direct testimony, and by the way, if you see me look off from the camera, it is because I have another screen I'm looking at for some notes. And if I turn away, it's not because I'm not paying attention or listening, it's because I'm looking at my notes.
Very well.
Now, if we could turn to hearing exhibit 115, this is your direct testimony at page 4. Here you indicate you're a managing partner with Atrium Economics, and that Atrium is a management and consulting and financial advisory firm focused on the North American energy industry. Is that correct?
Yes.
And your statement of qualifications is attachment RJA-1. And if we could pull that up for a moment, please. And looking at the header, I noticed that it is 15 pages. So is it accurate to say over your long career in utility management and consulting for gas, electric, and water utilities that you have been retained in most instances by the utility?
That's correct.
Okay. And just as a housekeeping note, I note that the labeling at the top, attachment RAJ-1 is not correct. It should be RJA-1. Is that correct?
That's right.
Yeah. All right. Thank you. If we could go to Mr. Piquet's direct testimony, hearing exhibit 116. And in particular, his attachment JJP-1. We see on line 8 an indication that $100,000 is the estimated cost for Atrium Economics to provide services for the decoupling proposal in this proceeding. Is that correct?
Yes.
Okay, now moving back to hearing exhibit 115, your direct testimony. On page 5, lines 5 and 6, you indicate your direct testimony is to present and support the company's proposed revenue stability mechanism, the RSM. Is that right?
Yes.
And on lines 6 through 8, you state the RSM that you are proposing on behalf of Piesco is a total revenue decoupling mechanism intended to separate the company's revenue from the volume of gas it sells. Is that right?
Yes.
And this proposed decoupling mechanism only applies to Piesco's gas department, residential, and small commercial rate classes. Is that right?
Yes.
And so to be clear, the purpose of the proposed decoupling mechanism does not apply to Piesco's other rate classes, such as large commercial, interruptible gas, or transportation customers. Is that right?
That's correct. And could I pause for a moment?
Yes.
I was planning to turn another light on that would not have me in the shadow.
Okay.
There we go.
Get that adjusted. You ready?
Yeah.
Okay. Thank you. Now, if we could move to your rebuttal testimony, which is hearing exhibit 134. And at page 5, starting on line 17, here you testify the RSM was specifically crafted to further enable Colorado's ambitious decarbonization goals. Is that right?
What line did you say?
I said that line 17 to 20 on page 5.
Yes. I see that.
Okay, very good. And if we could go to UCA's box account and bring up hearing exhibit 540. This is Piesco's response to UCA discovery request number 29-1. Do you see that?
Yes, I do.
And if we could move to the page 2, you'll see that you are listed as one of the sponsors of this discovery response. Is that right?
Yes.
I'd move to admit UCA hearing exhibit 540, please.
Any objections?
No objections.
So moved. So admitted.
Now, Now, with regard to the response on the bottom of page 1, as to subparagraphs A and B, in both of these responses, you indicate the reference testimony relates to Colorado's decarbonization goals, not specific commission rules. I'm sorry, there actually is a difference in subparagraph B. You state the reference testimony relates to Colorado's decarbonization goals, not specific Colorado statutory sections. Is that right?
Yes. Commission rules.
Yes. So this request concerns page 5, line 17 through 20.
Could I see the actual question?
Yes, absolutely. Let's go to the top of the page there on page 1. And you'll see that this request concerns your rebuttal testimony at page 5, 17 to 20, and your testimony that the RSM stability mechanism, the RSM, was specifically crafted to further enable Colorado's ambitious decarbonization goals. Do you see that in the first 3 lines?
Yes.
Okay. And so then your response is, what are the specific, to the questions in A, what are the specific Colorado Commission rules? And in B, what are the specific Colorado statutory sections pertaining to decarbonization that was specifically crafted? And you indicate in subparagraph A, is this correct, that the reference testimony relates to Colorado's decarbonization goals, but not to specific commission rules?
Yes.
And then in B, you state the reference testimony relates to Colorado's decarbonization goals, but not to specific Colorado statutory sections. Is that right?
Right.
Okay. And if the commission does not approve Piesco's proposed decoupling proposal in this gas rate case, this does not mean that the company will be unable to meet Colorado's decarbonization goals. Is that correct?
No, it does not imply that. We'll just make it more difficult.
Yes.
There'll be a financial strain on the company without being able to completely recover its commission-approved revenue requirement for the classes that are being included in the revenue stability mechanism.
Right. And if we turn to page 2, the top of the page, your response to subparagraph C basically just summarizes what you just said. Is that correct?
Yes, I guess it does.
And is it your understanding that if the commission does not, let me start over. Is it your understanding that if the commission does not approve Piesco's proposed decoupling proposal in this gas rate case, this does not mean that the company will somehow be forced to slow down its beneficial electrification efforts or other opportunities to achieve carbon reductions?
Well, I have no information that would indicate that they would do so.
Okay, thank you. If we could go back to your direct testimony. This is Hearing Exhibit 115, and on page 14, and at lines 10 through 18, here you provide a high-level description of the proposed RSM that generally describes the mechanics of the proposed RSM. Is that correct?
Yes.
And if we focus on lines 11 through 13, that first sentence of this high-level description, the predetermined revenue amount for the RG and CSG rate classes is not related to actual energy consumption by customers or by the impact of weather on sales or revenues, or affected by a decline in gas customers if customers decide to go all electric. Is that correct?
Right. It's based on the commission authorized revenue requirement for those two classes.
Okay. On lines 14 through 15, and this is your second sentence of your high-level description of the proposed RSM, here basing the predetermined revenue amount on the total non-gas revenue requirement for the RG and CSG customer classes as determined in this rate class would fully decouple Piesco's sales revenue for the residential and small commercial rate classes from the amount of gas sold to those rate classes. Is that right?
That's correct.
And if we look at line 16 through 18, this is your third sentence of the high-level description of the proposed RSM. The periodic quarterly true-up adjustments to rates is a true-up to predetermined revenue for the predetermined revenue amount for the RG and CSG rate classes. So the focus of the true-up is whether the determined revenue amount was achieved, and actual energy consumption, the impact of weather on sales or revenues, or a decline in gas customers would not be factors in this true-up analysis. Is that right?
I might ask you to repeat that.
Sure, I'd be happy to. Okay, referring to the third sentence, which is line.
And by the way, Mr. Bunker, you're kind of coming in and out in terms of what I can hear.
Oh, okay. I will try to do better. Sorry about that. Just let me know if you can't hear me. The periodic quarterly true-up of adjustments to rates is a true-up to the predetermined revenue amount for the RG and the CSG rate classes. So the focus of the true-up is whether the predetermined revenue amount is achieved, and not whether actual energy consumption, the impact of weather on sales or revenues, or a decline in gas customers would be factors in this true-up analysis. Is that right?
I'm going to object as a compound question. I think it might be helpful to break up the question into a couple of questions so we can make sure that we're getting a accurate response here.
Okay, I can do that. So again, we're focusing on the quarterly periodic true-up, right?
Yes.
And that true-up is to determine whether the revenue amount was achieved. So actual energy consumption is not a factor in the true-up. Is that right?
Well, it is to the extent that that actual energy consumption produces the revenue, the actual revenue.
But the revenue was already set by the commission in this case. Is that right?
The target was set, but it's being reconciled with the actual revenue that the company received during the quarter that's being evaluated from the customers. And that revenue is determined by their usage and the rates that are charged.
Okay. If the true-up focus of the true-up is whether the predetermined revenue amount was achieved, the impact of weather on sales or revenues would not be a factor in the true-up analysis. Is that right?
Well, again, it's a factor because the weather will have a determination on the actual consumption of the customers during that quarter. And that will produce a level of revenue that will be compared against the revenue target.
So with regard to a declining gas customers, you would say the same thing, that there is a stated revenue requirement stated in this gas rate case, and the true up would be with regard to, was that revenue amount achieved?
Yes.
So let's just do a simple hypothetical. So let's say the predetermined revenue amount for the RG and CGS rate classes, let's just say, let's use the number $10 million. Got that in mind?
Yes.
Okay. So we have $10 million, and then the true up occurs, and the revenue is $9.9 million. Have that in mind?
Yes.
So what would be the function of the true up analysis?
Well, it would make that calculation, and there'd be $100,000 of revenue that wasn't obtained. And then that would be used to create a recovery of that revenue over a subsequent 12-month period. So there'd be a unit amount based on expected volumes over that next 12-month period. And so that difference, that $100,000, would be turned into a unit rate that would be part of a recovery over the next 12-month period. And that's one of the protections built into the mechanism, because the quarterly adjustments by that very nature are smaller than if you were to do it on an annual basis. And because the recovery is spread out over the next 12 months, it also gives rise to a lower rate impact. And we modeled that, and I have examples of that in my testimony.
Okay, let me ask you this question, because I guess I see this hypothetical opposite of what you've just said, and that is, if the RSM is set in this case, and it is set at $10 million, and the actual amount at the true up is $9.9 million, is it inaccurate, or is it wrong that means customers were overcharged $100,000?
Well, first of all, the revenue requirement is essentially spread over the 12-month period as well. So by quarter, it would be established based on expected billing determinants, and therefore the expected amount of that overall revenue requirement to be captured in that quarter. And it doesn't mean that anyone was overcharged. It's just that the revenue didn't live up to that particular target revenue for that quarter.
I understand that, but wouldn't, for that quarter, customers be overcharged?
No, they would not. No,
about
because they're being compared.
$100,000?
They're being compared to what the authorized revenue requirement is for that class. So if they had actually brought in $10,100,000, they'd get a refund related to that quarter. And those incremental recovery or refund amounts are then spread out over the next 12-month period, and it cascades to the next quarter and the next quarter, so that the authorized revenue requirement is collected over a 1-year period in that fashion. It could have been, for example, that first quarter was warmer than normal, and therefore the actual usage by customers in that quarter was less than the target revenue requirement.
Okay, let's move on to a slightly different topic, and if we could bring up from the UCA box account, hearing exhibit 541. And this is Fiesco's response to UCA Discovery Request 29-2. And I direct your attention to the bottom of the page. And you are the sponsor of this discovery response, correct?
Yes, that's correct. What part of my testimony is this reference?
It is your rebuttal testimony. You'll see at the very top of the page, the request concerns your rebuttal testimony at page 6, line 2, and table RJA-R-1.
Okay.
Okay. And you are the sponsor of this response, correct?
Yes.
I'd move to admit UCA hearing exhibit 541.
Any objections?
No objections.
So moved.
If we could look at the top of the page there in subparagraph B of the request states, is it Mr. Amon's position that the RSM proposed in this 2024 gas rate case is not full decoupling? And in the response at the bottom of the page in B, you say, no, the proposed RSM is full decoupling as it is a full total margin revenue decoupling mechanism. Is that right?
Yes.
And if we could go back to your rebuttal testimony, which is hearing exhibit 134. And at page 7, starting on line 19 through page 8 at line 4, here you discuss Fiesco's decoupling proposal in its 2022 gas rate case, which is 24AL-0049G. Is that correct?
Yes.
And continuing down on page 8, at lines 15 to 18, here you say the company's present proposal was carefully and specially crafted to be responsive to the commission's findings in that proceeding, including its express concerns with the previous revenue per customer model. Is that right?
Yes.
And by that proceeding on line 17, you're referring to Fiesco's decoupling proposal in its 2022 rate case, gas rate case, correct?
Correct.
Okay. And at the top of the page on lines 1 through 4 on page 8, here you quote a finding from the commission decision, which you footnote at the bottom of the page is decision C22-0642 in the 2022 gas rate case about the unintended consequences of HB 21 40-1238. Is that correct?
Yes.
And is it your understanding that the decoupling section of this House bill, again, which is 21-1238, that was codified in the Colorado statutes as section 40-3.2-103, subparagraph 5B?
If you say so.
Okay, thank you. Well, I think you'll see on the bottom of page 6, you have a citation to that exact statutory section. So with that in mind, I
didn't recognize the all the numbers that you were quoting there, but that's fine.
Fully understand. And every state numbers their statutes differently and refers to them differently. So I perfectly understand. Is it your understanding that Piesco's decoupling request for the 2022 phase 1 gas rate case was based on this statutory section 40-3.2-103 subparagraph 5B?
Well, I believe it was formulated to reflect the intended policy statements from the legislation as codified, and it was therefore structured as a revenue per customer decoupling mechanism.
Okay. If we could go to UCA's box account, and this would be hearing exhibit 542. And you'll see that this is Piesco's response and supplemental response to UCA Discovery Request 29-5. And Mr. Amon, I would direct your attention to page 2. At the bottom there of that, top fourth of the page, you are one of the sponsors of the initial response to UCA 29-5. Is that correct?
This is 29-5. I can't see it.
It says at the top of the page there, this 29-5 continued on top
see.
of page 2.
Yes. Mm-hmm.
Okay, see that? And you're sponsors, correct?
Yes.
I'd move to admit hearing exhibit 542.
Any objections?
And this appears to be the supplemental response. Is that correct, Mr. Bunker?
It is both. The response is here on the second page, and the supplemental response is at the bottom of page 1. So it's both.
With that, I have no objections. I don't want to make sure it was the supplemental response.
Yes,
So
it is complete. It is there. And I'm sorry, Your Honor, did you say admitted?
Yes.
Thank you. So if we can look at the response on page 2, subparagraph A, here the response to subparagraph A states the reference statute was taken into consideration for the company's decoupling proposal in the 2022 phase 1 gas rate case, right?
That's my understanding.
Okay, and the statute, as you can see, is referenced again as the section we've been talking about, 40-3.2-103, subparagraph 5.
Mm-hmm.
See that at the in the request on the top of page 1. So the statute you're referring to, that was taken into consideration is this decoupling statute we've been talking about, right?
As I understand it, yes.
Okay. And is it correct that Public Services decoupling request in this 2024 Phase 1 gas rate case is not based on the statute, Section 40-3.2-103, subparagraph 5B, Roman I, or Roman 1?
Well, in one respect, I would agree, and that is it was not crafted as a revenue per customer decoupling mechanism, but a total revenue requirement mechanism based on the authorized revenue requirement for the two classes that were covered by the decoupling mechanism. And here, in my opinion, is where sometimes legislators are too prescriptive in terms of the details. And so what you have here is a situation where as time was passing, and based on the decarbonization goals, the clean heat plan, it was apparent that to us, in consultation with the company, that a revenue per customer approach would not deal properly with the throughput incentive, and that is to in a way encourage the company to continue to pursue new customers and new burner tips to increase load.
Okay, thank you for that response. Appreciate that. And so let me ask you this way then. You would agree the company's decoupling proposal is not directly predicated on Section 40-3.2-103-5BI. Is that right?
As I said earlier, in at least this aspect of that section that prescribed a revenue per customer approach.
Yes. Okay, thank you. Let's go back to hearing exhibit 134. And on page 8, at lines 15 through 18, you discuss how the company's present proposal was carefully and specifically crafted to be responsive to the commission's findings in the 2022 rate case. So you were involved in the crafting of this RSM for this case, is that right?
Yes.
And is it correct that by basing PSCo's proposed RSM, which is a full decoupling mechanism, on total revenues, the result is it would fully decouple its sales revenues for residential and commercial rate classes for the amount of gas sold to those rate classes in any quarter to maintain revenue stability?
Yes, its very name suggests it's decoupling companies' revenues from consumption.
Okay. if we could turn to Mr. Skluzak's answer testimony, hearing exhibit 500. And if we could go to page 216 when you find Mr. Skluzak's testimony, please. Page 216, lines 11 through 17. In this testimony, Mr. Skluzak opines that Piesco's decoupling proposal does not adjust for the impact that weather has on sales and revenues. Do you see that?
What lines are you pointing to?
I am pointing to lines 11 through 17, and specifically the question and answer on 16, line 16 and 17, where Mr. Skluzak opines Piesco's decoupling proposal does not adjust for the impact that weather has on sales and revenue. Do you see that?
Yeah, I see it.
Okay. Since the proposed RSM is based on a predetermined revenue amount for the RG and CSG rate classes, factors that benefit customers in the residential and small commercial rate class, like the impact of weather on sales or revenues, or the actual energy consumption by the customers, that does not change the predetermined revenue amount. Is that correct?
Well, the predetermined revenue amount is based on billing determinants under normal weather. And so the authorized revenue requirement for those two classes is therefore based on normal weather. And
Okay.
therefore, I disagree with this statement and answer because if weather is warmer or colder than normal, it will be reflected in their actual consumption, and therefore the revenue that will be received that will be compared to the authorized revenue requirement for the class under normal weather.
Okay. Is it your testimony, Mr. Amen, then that even with a requested increase in the revenue requirement of roughly $170 million in this proceeding, and with Piesco Gas's current riders and adjustments, such as Piesco's $11 per month residential service and facilities, or S&F charge, and other charges such as interstate pipeline and natural gas charges, and the extraordinary gas cost recovery rider, even with all those charges, Piesco Gas would not be able to recover its fixed cost required to provide safe and reliable service through its volumetric rates if the RSM proposal is not approved?
I'm going to object as a compound question. That was a very long question. We could break it up. It'd be helpful to get a accurate response here.
You could break it up, Mr. Bunker.
Sure.
That'd be great.
Sure. Is it your testimony that first, let's assume that the revenue requirement of roughly $170 million in this proceeding is approved? Got that in mind?
Yes.
And that Piesco Gas currently has various riders and adjustments, including a $11 a month residential S&F charge for its residential customers. It also has one, I don't have it at the top of my head in terms of small commercial classes, but that there are S&F charges. Got that in mind?
Right, and those are part of the base rates. Those aren't riders?
That would be attached to the base rates, but there's other charges like pipeline and natural gas charges, correct?
Yes, those are flow-through items.
Yeah. And if you recall, there was a winter freeze in 2021, February of 2021. And as a result, there is what is called the Extraordinary Gas Cost Recovery Rider Charge. And that allows public service gas, as well as electric and other utilities also, to recover a charge for these extraordinary gas costs during that 5-day winter storm. So you have that in mind?
And do I understand that it is to spread over some months the exorbitant costs of natural gas that were incurred during a severe weather event like Storm Uri?
Yeah, exactly. Yes, that is correct.
Okay. So those two are gas costs that would be a flow through to the customer.
Understandable, but that's still on a customer bill, agree?
It may be, yes, but it doesn't recover the company's cost of distribution service.
Okay. So let me ask you this question then. Is it your position that Piesco Gas would be unable to recover its fixed costs required to provide safe and reliable service through its volumetric rates if the RSM proposal is not approved?
Well, it would certainly make it more difficult, and it would not
Mr. Amon,
account for.
Mr. Amon, if I could interrupt, I think my question was a yes or no. So
I'm sorry, I need to interrupt for a moment. Somebody's trying to call me and I need to cancel it. Okay. So you think it's a yes or no question?
yes, I believe the way I posed the question, it would be yes or no. So if you could answer yes or no, would be
I disagree.
okay. So you're saying if the RSM proposal is not approved, public service would not be able to recover its fixed costs. Is that right?
Objection, it mischaracterizes his testimony. He was disagreeing with the fact that he believed the question was a yes or no question.
If you could reframe the question, Mr. Bunker.
Sure. Mr. Amon, if Piesco Gas, let me start over. Piesco Gas would be unable to recover its fixed costs required to provide safe and reliable service through its volumetric rates if the RSM proposal is not approved. Is that your position?
The situation where the company may not be able to recover its fixed costs can be driven by extreme normal weather, so that the revenue received does not help them to cover their revenue requirement. It would provide them with an incentive to increase customers and increase consumption to try and make up that difference, and is contrary to the goals of the clean heat plan and the reduction in carbon. So it essentially pits the company against these policies in order to try and collect enough revenue to cover its authorized revenue requirement, notwithstanding the fact that they still have to deal with escalating costs and manage those costs. in order to recover them.
Okay, thank you, Mr. Amen. I have no further cross-examination.
Thank you, Mr. Bunker. Commissioner Plan, any questions?
No, I do not.
Commissioner Gilman, any questions?
No question.
I don't have any either. Any redirect, Ms. Herring?
Very briefly, Chair Blank. Mr. Amen, can you do you recall your discussion with UCA Council about decarbonization?
Yes.
How will the RSM further Colorado's decarbonization goals?
Well, it will provide the company with the ability to recover its authorized revenue requirement for the classes included in the RSM, and therefore eliminate any disincentive to work to its fullest to implement the very important decarbonization goals. And in the process, it also aligns the interests of both customers and the company when it comes to the risks that both share due to changes in weather that impact customer bills and the company's ability to recover its costs. So I think it's the right mechanism at the right time to provide removal of certain disincentives and allowing the company to rigorously work towards achieving those clean heat goals while not being subject to any degradation in its financial health.
Thank you, Mr. Amen. Do you recall the conversation with UCA Council about the difference between a total decoupling mechanism and as opposed to a revenue per customer model?
Yes, I remember that conversation, yes.
My question for you is, why did the company propose a total revenue decoupling mechanism in this proceeding?
Well, it's revenue, first of all, its revenue per customer approach was disallowed. When I hesitated there at first, they were both full decoupling mechanisms, but one being revenue per customer and one being the total revenue requirement. And I think again, the total revenue requirement approach is the solution for the times.
I have nothing further for this witness.
Thank you, Mr. Raymond. You may be excused, sir.
Thank you.
I'd like to get started with, I think Mr. Pette is the next witness, and see if we can at least get through trial staff, and we'll have a hard stop at 3:25. So there you are. Mr. Pette, can you hold up your right hand? Do you swear to tell the truth, the whole truth, and nothing but the truth?
Yes, I do.
Put your hand down. Is anyone in the room with you or communicating with you in any way?
No, they are not.
If that changes, you'll let us know.
Yes, I will.
Back to you, Ms. Samard Pacheco.
Thank you, Chair. My computer crashed, so I need just a second for Word to open up, but I am here, so I just need 1 second. Computers never cooperate when you need them to. Okay. Mr. Pette, could you please state and spell your name for the record?
Yes, my name is Jason, Jason, Pette, Peuquet.
By whom are you employed and in what capacity?
I am employed by Public Service Company of Colorado as the Director of Regulatory Administration.
And for purposes of this matter, did you prepare hearing exhibit 116C Rev 1 as your direct testimony?
Yes,
And hearing exhibit 122 as your supplemental direct testimony?
yes,
I don't believe you had any corrections today to either your direct or supplemental direct testimony. Is that right?
that's correct.
Turning to your rebuttal testimony, hearing exhibit 135, as well as your attachment JJP 14 to that hearing exhibit, do you have corrections to those two documents?
Yes, I believe I did.
Could we please start by pulling up hearing exhibit 135, attachment JJP 14 Rev 1 from the company's box?
Yes, it's doing that syncing thing again, so I just have to pull it from the web version. Give me just a second.
No problem. If it's not there, let me know. We'll try to get it there as soon as possible.
It's an executable, right? Executable attachment JJP 14.
That's correct.
Okay, give me just a second to get that open.
Thank you. Mr. Pette, could you please walk us through the correction that was made and why it was needed?
Yes, I believe the correction is in cell F 21, it looks like, that number highlighted in red to the top right. I believe there was a formula error before, something in the range of 32,000, but it's corrected to say about 7,000 now, and that is the difference between columns D and E, showing the remainder in costs for one of the consultants in this case.
And did we add a revisions tab to this exhibit so that the changes could be more clearly seen?
Yes, I believe at the end we have one.
If you could please click on the revisions tab, Ms. Frederico. And does this reflect in red with the correction description, the changes that were made?
Yes, it does.
And these changes did not flow through to your rebuttal testimony, did they?
No, I did not believe this changed any numbers in my written testimony.
Perfect. If we could also now then pull up hearing exhibit 135, his rebuttal testimony, I guess it would be Rev 1. And if we could please go to page 40. If we could scroll down, there you go to line 14. I believe you have the same change also on page 42. Could you please explain this change?
Yes, these couple changes refer to the gain on sale from the Golden Service Center land. We had corrected this in my direct testimony, changing it from 4.7 million to 4.8 million, and unfortunately had missed that same correction to a few references to that number in my rebuttal testimony. So simply flowing that through here.
Thank you. With that, the company moves for admission of hearing exhibit 135 Rev 1 and hearing exhibit 135 attachment JJP 14 Rev 1.
Any objections?
No objection.
So moved.
Mr. Pette is now available for cross-examination.
Mr. Horman, 30 minutes, sir, and I may have to cut you off at
No
the
problem.
end. We'll see
Try
how
to
we
see
go.
if we can get it done in 25 minutes here.
That'd be awesome.
Good afternoon, Mr. Pette. My name is Josh Horman, and I represent trial staff in this proceeding. It's nice to meet you.
Nice to meet you as well.
I have a few subject areas that I wanted to discuss with you, and the first one is the Golden Service Center. In your rebuttal testimony, you testified that the Golden Service Center is on land owned by the company's electric business, correct?
That's correct.
And that fact was discovered after you filed direct testimony?
The fact that it was solely owned by the electric company was something that we uncovered in the process of preparing rebuttal testimony.
Okay, but would you agree with me that it would be more appropriate to address the sale of the Golden Service Center in the company's next electric rate case?
Your question was, would it be more appropriate?
Yeah, would it be more appropriate to address the sale of that land in the next electric rate case versus this proceeding?
That's correct. That's the company's recommendation here, both for the sale of the land as well as for the buildings.
Okay, thank you for that clarification. And really, what I'm asking is, the Golden Service Center land is not an issue in this proceeding, correct?
Correct.
Thank you. And now I'd like to turn to the rifle plant Q-Star project. Mr. Pette, have you been listening to the hearing this week?
Yes, I have.
And do you recall Mr. Gardner's testimony on the rifle plant Q-Star project?
Yes, I do recall that.
Did you hear Mr. Gardner's conversation with the commission?
Yes.
And do you recall where Mr. Gardner mentioned that he was unaware of any concerns with Rocky Mountain Natural Gas regarding this project?
Yes.
And I believe he designated you as in the role of implementing the project. Is that correct for the company?
I don't believe that specific reference to me in that conversation, but
sure. Let me rephrase. You do have a role in this project, correct?
to the extent that it influences our regulatory proceedings, both in this case and potentially others, yes.
Okay. And do you know if Rocky Mountain Natural Gas has voiced any concerns to the company and how the Q-Star project will impact the rifle processing plant?
I'm not directly aware.
Do you know if Rocky Mountain Natural Gas has had the opportunity to voice any concerns?
I believe there was
I would object as this being outside the scope of Mr. Pette's testimony. His testimony on the Questar project is limited to the regulatory processes, as he indicated, and whether a CPCN was required.
Overruled. If the witness doesn't know, the witness can say, keep going, Mr. Horman, and we'll see what Mr. Pette says.
Would you like me to re-ask the question?
Please, thank you.
I just asked has Rocky Mountain Natural Gas had the opportunity to voice any concerns?
I believe there was some conversation of this project in a recent Rocky Mountain Natural Gas rate filing or other filing, to which the company was not a party. I'm not aware of any other proceedings at the moment.
And would you agree that a joint study would be an opportunity to understand and address any issues if Rocky Mountain Natural Gas had any?
Again, referring to that prior proceeding, I believe there was discussion of this fact. The company continues to talk to its partner on this project, related to some of our assets down in the Rifle region, which includes Rocky Mountain Natural Gas. We talk to them regularly as a result of that, but I'm not aware of specific requirements or lack of requirements about specific studies.
Well, in your opinion, do you think a joint study would be helpful?
I would renew my objection. This is a regulatory witness. We testified about regulatory processes and not the relationship between the two companies.
So noted, but overruled, again, Mr. Pette, if he's outside his expertise, we'll say so. Mr. Harmon, keep going.
Do you think a joint study would be helpful?
Again, without more specifics of what would be included in such a study, I can't opine.
Okay, thank you. I'll move on to my next subject matter area, which is gas storage inventory costs, or GSIC. Are you familiar with the FERC uniform of accounting?
At a high level, yes.
And is that something that could be possibly better asked to Mr. Freitas?
Yes.
Okay. And please just defer me to witness Freitas if you can't answer this, but does the company apply the FERC definition of current asset to GSIC?
I'm sorry, that's probably a better question for Mr. Freitas.
Okay, I'll move on to my next question then. Would you agree that regulatory assets that receive a return at WACC are typically those that are expected to be recovered over a longer period, let's say over a year, through customer rates?
Could you rephrase the question or restate it rather?
Yes. Would you agree that regulatory assets that receive a WACC return are typically those expected to be recovered over a longer period, over a year?
I would answer slightly differently, that the company receives a WACC return on its assets in rate base, generally. And so some of those are short-lived assets, some of those are longer-lived assets. It's a combination. It reflects the company's weighted average cost of capital by definition.
Okay. Would you agree that it's generally good financial policy to finance short-term or temporary assets with short-term sources of financing?
I would disagree.
I'd like to turn your attention to your direct testimony, hearing exhibit 116 at page 49. Ms. Federico, if we could bring that up, please. Or is it Ms. Kunkel? I'm sorry.
No, you were right, Miss Federico.
Okay. Thank you, Ms. Federico.
What page did you say? 49?
49, lines 16 through 19, please. Okay, Mr. Piquet, can you read the sentence starting with providing a return on gas storage inventories?
Yes, it says providing a return on gas storage inventories that is below the actual cost of financing those assets, however short-term in nature they may be, ultimately provides a financial disincentive to developing and relying on those assets fully.
Thank you. And regarding the use of financial disincentive here, will the company reduce the overall amount of physical stored gas if the return remains at the short-term debt rate compared to the WACC rate?
That's not what the company's saying here. It's simply noting that there's a penalty with this type of a treatment afforded to gas storage assets, that it's not commensurate with the actual cost the company incurs to finance those assets.
So the company wouldn't purchase less gas if the GSIC earns a short-term debt rate, correct?
I can't say at this time whether we'd purchase more or less. I'm just noting that there's a penalty, and as we conduct our business, we'd have to take that penalty into account. Whether or not that would actually change the purchasing behavior, I can't comment on at this time.
Okay, Ms. Federico, we can take this exhibit down. Thank you. Mr. Piquet, isn't it true that a WACC return is generally higher than a short-term debt return?
I'm sorry, I was distracted. The lights came off in here.
No problem. Did the same to me. Isn't it true that a WACC return is generally higher than a short-term debt return?
Correct. Yes.
And the GSIC gets recovered through the gas cost adjustment, correct?
Yes, currently, although my testimony talks about how in the past it used to be an element of base rates.
Okay, and the GCA is a component of a customer's monthly bill, correct?
Yes.
So wouldn't a WACC return create higher bills to customers as compared to short-term debt return?
if we think about it, all else equal, a short-term debt return compared to our WACC return on any given asset will produce a higher cost when a WACC return is applied. I would agree.
Okay, Ms. Federico, can we actually bring up hearing exhibit 116 again and go back to page 49, please? Okay, now if you could scroll up to lines 5 through 11. Oh, I apologize. This is actually, I meant to say hearing exhibit 135. I apologize, your rebuttal testimony.
Same page 49 in 135.
I could just have one moment. Ms. Federico, could we take this exhibit down, please, actually? I'm going to ask Mr. PK a question before referring to his testimony. Do you remember Mr. PK talking about various reasons for in disagreement with the staff's recommendation to continue GSIC?
Disagreement with which recommendation specifically?
I'm specifically referring to your recommendation related to policy, in which you state, in light of the companies, the commissions, Colorado lawmakers, and customers' more acute interest in service reliability and rate stability, in light of extraordinary storms and gas prices witnessed in recent years. Do you remember
Yes.
all that testimony?
Yes.
Okay, and are you generally familiar with Winter Storm Uri?
Yes.
In your opinion, would Winter Storm Uri qualify as an extraordinary storm?
Yes.
And that storm occurred in February 2021, correct?
Correct.
In the company's last gas rate case, proceeding number 24AL-0049G, was litigated in 2022, correct?
Correct.
Is it your understanding that the commission approved short-term debt return for GSIC during the company's last gas rate case?
That's correct.
So would you agree with me that part of the company's request to alter the recovery of GSIC is policy-based?
Yes. In my testimony, I'm making policy arguments for why a short-term debt return is not as appropriate as a WACC return.
Are you aware of any federal, state, or commission policies that would necessitate revisiting the company or the commission's decision in the last rate case on GSIC?
I would object to on the grounds it calls for a legal conclusion.
If I may respond, Your Chair.
Can you just rephrase, please?
Yes. Mr. PK, are you aware of any federal, state, or commission policies that would necessitate revisiting GSIC?
Not that would necessitate doing so.
Okay, thank you. I'm now going to turn your attention to decoupling, and the company has proposed a full decoupling mechanism based on total revenues in this proceeding, correct?
Yes.
And that is the company's proposed revenue stability mechanism?
Yes.
And if we could pull up Mr. PK's rebuttal testimony, hearing exhibit 135, page 32, please. Okay, if we could. Do you recall, let's see here. Do you mind scrolling down a little bit, Ms. Federico? Thank you. I'm looking at lines 10 through 13. Mr. PK, do you recall stating in your rebuttal testimony that the RSM is an important tool to consider as the company faces a potential financial disincentive associated with decreased sales volumes from policies such as conservation and beneficial electrification?
Yes, that's what it says.
So is it the company's position that the company currently lacks sufficient financial incentive to implement programs promoting conservation and BE?
I would answer differently than that. The RSM, as Mr. Amon was discussing previously, really tries to align the company's financial interests and those of the public policy interests of the state. And that doesn't mean we're not going to do everything we can to implement DSM programs, to implement new clean heat programs that were just recently approved, but it's helpful when we're all rowing in the same direction, that there's no potential conflicts once we think about all the company's employees, all the programs at hand, all the interactions we have with customers, potential customers, and stakeholders, that we're all pushing and aligned in the same direction.
Mr. Piquet, I appreciate your answer, but I don't think I heard a yes or no.
Would you mind restating the original question?
Sure. Is it the company's position that the company lacks sufficient financial incentive to implement programs promoting conservation and beneficial electrification?
I'm saying it's not a simple yes or no answer.
If it was no, if it's no, why is the RSM necessary?
Objection. He said it's not a simple yes or no answer.
Sure, I'll move on. And just for clarification, though, the company does consistently earn a bonus for its performance under the DSM plan.
Yes, that's correct. We've been achieving above our target for several years now, I believe.
The company generally has been able to meet or exceed its company or commission approved DSM targets. Is that right?
Yes, as I just stated.
And one component of the company's DSM incentive structure is the acknowledgement of lost revenues, or DSM ALR.
That is one component, yes.
So in other words, the DSM ALR already compensates the company for every therm lost as a result of conservation and electrification.
It compensates the company at a certain level for therms saved or concerned or conserved through DSM programs specifically.
So doesn't the DSM ALR already remove any financial disincentive associated with DSM conservation or BE?
I would disagree with that.
Mr. Piquet, have you reviewed staff witness Haglund's testimony in this proceeding?
Yes, I reviewed his answer testimony.
And are you generally aware that staff's primary recommendation is that the commission should reject the company's proposal to implement decoupling in this proceeding?
Yes, and he also has an alternative proposal that would change some of the specifics of it if it were implemented.
You nearly answered my next question. So is it your understanding that staff recommends in the alternative approving partial decoupling?
Yes.
In your rebuttal, you testify that staff's alternative recommendation for partial decoupling is not the right approach. Is that correct?
That is correct.
And I'm sorry, Mr. Federico, you can take this exhibit down. Thank you. Under the company's proposed RSM, the company would calculate and apply RSM on a quarterly basis, correct?
Yes, it would be under 3-month increments that wouldn't exactly align with calendar quarters.
And while the company proposes an annual true-up as part of RSM, there would be no cap on increased adjustments to the RSM, correct?
I disagree with that. The mechanism itself is naturally capped by the fact that we'd be recouping the fixed cost approved in the prior or the most recent gas rate case, and no more, no less, from those rate classes in question.
Okay. Do you recall stating that RSM would have been impactful for customers in 2022, 2023 because of colder than normal temperatures and higher than normal gas commodity prices?
That's correct.
Okay, and if that situation were to occur again, would your position be that RSM would be impactful because it would provide a refund to those ratepayers?
Yes, it would have, if it had been in place during that heating season.
But isn't it true in that situation, the over recovered amount doesn't provide a refund until the next quarter?
It provides a refund in the next quarter. That takes 12 months to fully be returned or surcharged to customers.
So would it be fair to say that the refund doesn't provide short-term relief in that situation if it's spread over 12 months?
Well, I would say, given that it starts within 3 months, that's pretty timely. It's much more timely than an annual mechanism, which we think is one of the benefits of this proposal.
All right, thank you. And now I'd like to turn your attention to your rebuttal testimony, hearing exhibit 135, page 37, line 11. Mr. Pette, do you see where you state that staff is inconsistent on its approach to decoupling?
Yes.
Are you you already testified that you're familiar with the company's last gas rate case, correct?
Yes, I was not involved in that case, but I'm familiar with it.
Okay, well, are you aware that staff advocated that any approved decoupling mechanism should be a partial decoupling mechanism?
In the last gas rate case, yes.
Okay, but as an example of staff's supposed inconsistency here, you cite an electric decoupling pilot from 2016 in which staff recommended full decoupling, correct?
Correct.
And you're familiar with the electric decoupling pilot because you were a witness for staff, correct?
Correct.
So you recall that the company in that proceeding, and I'm talking about the electric pilot, advocated for partial decoupling, correct?
Yes, the company's proposal in that proceeding was for partial decoupling.
So based on the company's position of partial decoupling for the electric pilot and the company's proposal here for full decoupling, isn't the company's approach to decoupling inconsistent?
We've tried to take into account the feedback heard from other parties as well as the commission as these decoupling conversations have evolved in recent years. And we've taken that feedback into account into this latest proposal here in this rate case.
But would it be more consistent for the company to roll out a decoupling gas pilot like it did with the electric pilot proceeding instead of the RSM?
No, that would not take recent feedback into account.
I could just have one moment.
Yep.
Mr. Pette, thank you for your time. I have no further questions.
Thank you, Mr. Horman. Ms. Brahma, what are we doing with Mr. Matley? Can we start off Tuesday?
Actually, I'm going to answer your question, Chair, if that's all right.
All right, sorry.
First, with a bit of good news, the company has decided to waive its cross of witness Lemaire. So we wanted to make sure we pass that along before the weekend.
Commissioner Plant, any questions for Mr. Lemaire?
No, I do not.
Commissioner Goman?
Hit me a little by surprise. I don't know 100%. I think it's probably fine.
All right, we'll take that up first thing on Tuesday.
Okay. Let me move on then to Mr. Matley's testimony. There are a couple of issues that we wanted to discuss with the commissioners. First, with respect to your request regarding his hearing exhibit 123 attachment RAM4 and the request that we make it public rather than confidential. The company has determined that it will remove subject to the commission's approval, we can remove the confidential gas forecast, and we propose to replace that forecast with actual gas costs to date and escalate those actual gas costs with a user-defined escalation rate, which will be defaulted to 2%. to align with the generic escalation rate included in the model. If that is acceptable to the commission, we can prepare that public version, and we would propose to file it in e-filings on Monday so that the commission and parties can see it before hearing on Tuesday, and we can email it to the parties as well. And then we can formally deal with admission at the hearing on Tuesday.
That'd be great. Thank you.
That will also require some.
Commissioner Gilman, did you have comments on that?
I just wanted to confirm that'll be an executable version that you'll provide Monday. Okay. Thank you.
And there will be some flow through changes to Mr. Matley's testimony as a result of the changing numbers. So there may be some changes to make there. There's one other matter that we discovered yesterday in with respect to Mr. Matley's supplemental direct testimony. While he was preparing, again, I said it was yesterday, his attachments RAM1, RAM2, and RAM3, which are all the revenue and revenue requirement analyses associated with those select new business projects that we've been discussing during the hearing, including Canyons, Coal Creek Canyon, and Rampart Range, had an error in the calculation of depreciation expense. Those attachments were calculating only the life portion of depreciation expense and not the cost of removal portion of depreciation expense. So we also plan on correcting those attachments as well. We propose to undertake the same process and file those, provide them to the parties, and then we can deal with those also on Tuesday. But it's a little more than just a simple mathematical correction. We noticed a substantive error. So if that's acceptable to the commission, we're not asking for any action on the exhibits right now, but thought it might be a bit more accurate to include that input.
If you could file that on first thing on Monday, I do have questions for him on those exhibits. And if it's, I would like to see them before Tuesday if possible.
Yeah, that's our plan, to file all of the things that I mentioned on Monday. Understanding we'd also have to have them in our box and then formally move for admission and deal with them properly at hearing.
Right. That'd be great. It would not be part of the record on Monday, but at least it would let people look at it and prepare.
Assuming that's okay with Commission Council as well and the parties.
Yes.
I saw you come on, so I thought I better ask.
You came to the same resolution.
Thank you.
Anything else?
No, I think that's all. Anything else? Nope.
Ms. Crampton, I saw you had your video on. Did you have a final matter before we adjourn?
I had just been ready for cross-examination. So just to clarify, are we picking up with Mr. Matley on Monday because of scheduling, or I'm sorry, on Tuesday, or will it be Mr. Pette?
I think we should finish with Mr. Pette and then go to Mr. Matley and then go to Mr. Freitas. Would that work for you, for the company?
We would actually like to fit Miss Bulkley in there somewhere on Tuesday. So I would suggest that Mr. Freitas go last, and I don't think it matters to us whether Mr. Matley or Miss Bulkley go after Mr. Pette. It's at the preference of the committee.
So can we do Pette, Matley, Bulkley, Freitas?
That works for us.
And we're a little behind. Would you guys be open to starting at maybe 8:30, or should we just stick to 9? Is this too inadequate notice?
For the company, you read our mind. We were feeling like we're a little bit behind as well, and we'd be happy to start at 8:30.
Commissioner Gilman, Commissioner Plant?
Not a problem for me to start at 8:30, and I know we'll wrap up very quick. So I did just want to say, Mr. Marpachenko, I appreciate you all looking into that issue today with regard to the confidentiality, and I think coming to a reasonable resolution to use some generic values there to really enhance the transparency here. So I appreciate it.
Thank you.
I'd echo that. So there's a commission vote expressing our appreciation. Commissioner Plant?
It's unanimous. I have another meeting, but I can try and move that and start at 8:30 on.
We can start at 9 if it's
I don't want to hold things up. We'll
all right.
at 8:30 is fine.
So 8:30, and if for some reason we have a problem with the legal assistance or with counsel, we'll circulate a notice. Any other final matters before we adjourn for the weekend?
No, we appreciate the kind words, and we look forward to seeing everyone on Tuesday, and we will make those filings as soon as possible on Monday.
Greatly appreciated it. 8:30 on Tuesday. Thanks, everybody. Have a good weekend.
Thank you.